us. Get ahead.
Some of the wider sector lowers, so we'll watch that for the European session as well. Reckitt Benckiser, of course, the maker of all kinds of household products, the consumer giant, reaffirming its revenue outlook and actually saying, delivering a sales decline that might be better than expected for some people around some of its US baby formula news. Guy.
Let's talk about the opening trade. Here we go here in Europe this Wednesday morning. We are anticipating a soft-ish start to the morning, but you really want to dig below the surface and see what's happening at a sector level, what's happening at a single stock level, because key names are going to matter this morning. So London, a little softer. The IBEX, as Critty was mentioning, well, struggling in and out of positive and negative territory, trying to find some headway, trying to find a sense of direction, struggling with that a little bit. We'll see how the DAX opens this morning with Deutsche Bank. The CAC 40, L'Oreal is going to be a big feature of that market as well. The Stock 600 down by just 0.1% at the moment. In some ways, if you park the earnings story to one side, it is a very macro market. It is what is happening in the States, the election story, what's happening with the Fed, what's going on therefore in the bond market, the dollar that seems to be actually setting the tone at the moment. But the single story, stock story, bottom-up story, I think this morning is hugely significant. So, Critty, what's going on?
Well, you know, it's interesting. Ahead of the futures, you pointed out, I would say there may be some optimism out of Spain right out of the gate. Some of your biggest kind of index contributors to the upside in the Stock 600 are indeed Spanish stocks. And when you look underneath the surface, it is coming from perhaps some questions around Spain considering a cut of the windfall tax. You know, this isn't something on large energy firms. This isn't usually something we talk about at the open, Anna, but it is enough to move the upside in terms of the Stock 600. So that's one stock we're keeping, so one sector we're keeping an eye on. The other is weakness in France, and that seems to be driving things to the downside.
Right, and you're right to point out that Spanish story, because utilities is the best performing sector this morning, and that is being led by Iberdrola and some other Spanish names in the mix there as well. The banking sector also doing pretty well, up by 0.3%. Of course, we've had news from the banking sector today. Lloyds Banking Group is one of the names in there, up by around 1.9%. We've also had numbers out of Deutsche Bank, we know, but that story is more negative. That one down by just shy of 2%, so something disappointing investors around the Deutsche Bank story. So a mixed picture on bank, but overall the sector is going higher, perhaps responding to that overall higher interest rate environment, higher yield story. Maybe that keeps profits on net interest margin more positive for longer. Maybe that's the thinking. Once again, I think that was the trend yesterday as well.
Svenska Handelsbank doing very well this morning. Lloyd's doing okay this morning. So there are some names that are certainly lifting that sector. Lloyd's doing very well on the back of its numbers this morning. But Deutsche does look a little bit of a laggard, maybe.
Yeah, on the other side of that, L'Oreal taking a beating. Those French stocks now properly open, getting that proper volume at the opening trade, down a whopping 3%. You saw some of the other French names again. Airbus as well was taking a beating this morning as well. So again, you are seeing the underperformer in Europe right now, going right back to France. But Germany seems to be the outperformer.
It's interesting the industrials maybe under a little bit of pressure. Big day yesterday for the industrials. You saw Lockheed Martin coming down. You certainly saw GE under significant pressure, but both stocks have had a great run. Today, it's all about Boeing. We're going to get the numbers out from Boeing very shortly, well, as the US opens up, and then as we work our way through the night into tomorrow, we're going to get this key union vote.
A lot going on in the U.S. corporate sector that may be feeding into the sentiment in Europe, as Guy was pointing out. Then there's the hangover of the U.S. election as well. We are 14 days away. Deutsche Bank CFO James von Moltke says he's expecting that U.S. strength once the election is out of the way. Take a listen to what he had to say.
We're off to a good start in the quarter, so that's encouraging. We think the conditions of the third quarter have carried through without the volatility, incidentally, that we saw in August. Usually, we see strength around a U.S. election, you know, as investors and also corporates need to position and react to changes in the markets and expectations. And so that's what we'll expect to see, really, once we get past the milestone on November 5th.
Let's bring in Wells Fargo macro strategist Eric Nelson joining us around the table this morning. Is the election going to be as much of a tradable event as we're expecting? We're expecting a lot of things to change if Donald Trump gets a second term. Kamala Harris, maybe status quo. Is this just one of those events where we kind of dread a little bit in terms of the trading narrative when it really will come back to the Federal Reserve?
It's certainly possible. I think also we have to keep in mind that we might not get a result for maybe even a few weeks. At the very least, a couple of days is very reasonable to expect that. Look, in the U.S., the fundamentals are still pretty good economically. You know, corporate profitability is still high. Labor market is still chugging along. What strikes me is, though, this time sort of looking at Trump and the Trump trade is a little bit different, right? Back in 2016, no one expected a red wave, and it's exactly what we got. This time around, it's kind of the base case, right? And also, no one was talking about trade and tariff risk back then. This time around, it's a very real risk, and the numbers being floated are much larger. So I'm not sure it's an unequivocal positive for risk if Trump wins, and certainly the composition of Congress will matter in terms of the implications for fiscal policy.
So what does that do? It feels like those are competing factors then for the bond market here. If you're talking about that tariff risk in a Trump 2.0 or even in a Harris presidency as well, where she may carry on the tariffs that have stuck during the Biden administration as well, it feels like that's inflationary, especially in the context of a looming deficit and budget ceiling in January. But then could you see the Federal Reserve and other central banks around the world step in to reassure the markets, to reassure the bond market, and create more insurance cuts? Those feel like competing factors. What's going to win out?
Well, yeah, I think the challenge here is, you know, if you have tariffs and very expansionary fiscal policy, that sounds like a recipe, as you pointed out, for inflation, and also maybe still relatively solid nominal growth. That sounds like a recipe for fewer Fed cuts, right? And there's all sorts of talk around, you know, will Trump interfere with the Fed? There's not a lot he can really do. You know, to amend the Federal Reserve Act, you need 60 votes in the Senate. I don't think he has that. So, you know, are we sort of misjudging here the reaction function from the Fed? Will there be fewer cuts? Will that impact kind of the front end of the curve as well? I'm not sure this question is being asked enough.
Okay, so if we were to ask you, what would be the answer? And is it as simple as if Trump wins, you buy the dollar, if Harris wins, you sell the dollar, considering current positioning right now?
Well, I think you've already seen some of this trade come through, right? So I think you do see some, certainly if we have a delayed result, you see maybe some profit taking as people kind of wait for the final result. I do think that if Trump wins, you do see probably further dollar strength. It's mostly a trade and tariff story.
Yep.
As we look further out, you know, we go back to 2019. Eventually, the trade and tariff issue became demand negative, and the Fed started to actually ease policy, right, as a result of these tariff announcements. So further out, we could see some two-way risk for the dollar, but I think the near-term reaction probably still is dollar strength.
In terms of kind of how you position on the curve and what you would see likely happening, just kind of how many scenarios, what do the tail risks look like right now around all of this? How fat are those tails? The uncertainty seems absolutely enormous at the moment. How do I hedge risk around this? Because we're basically facing an incredibly consequential but incredibly binary event that we may not get the result for a few days, but nevertheless the consequences over the next few years could be significant. How do I hedge that?
Well, I think you have to consider, you know, in FX space, for example, we have certain trade risk that's very idiosyncratic, right? To me, Europe is an obvious target for the Trump administration. They've talked about this at length. We know Lighthizer, Trump's sort of trade czar.
The Europeans are going to respond. So
absolutely.
It could get really ugly really quickly.
Exactly. And this is why I think euro is a great place to look as kind of a short, as a hedge, if you do see that Trump victory. But also you need, looking at it versus the dollar to me is a little bit too binary for sort of a, will Trump win, won't he win? I think you look at it versus, say, a Canadian dollar, where you have, exposure to possible Trump stimulus, but also sort of protection from the USMCA. I think really most of the U.S.'s issues in USMCA are focused on Mexico, not Canada. Yeah. So I think there are some relative value plays in FX you can look at as hedges.
Eric, are there themes that you want to invest around that are sort of election-proof? I'm not sure if there's such a thing, but are there things that we are investing in right now, big structural shifts that are underway in the global economy, and you think that they will be sustained regardless of who is in the White House or the makeup of Washington?
Well, we talk to a lot of corporates in the U.S., and one thing that seems to be pretty much unequivocal is this, very gradual rotation away from China as part of the supply chain. Right, we've seen consistent moves toward nearshoring in North America, also looking at India, other places in Southeast Asia. This has been, and I think that's kind of theme that is somewhat election-proof. Now, obviously, Harris and Trump are different in terms of the degree of their sort of sharp tone toward China. But to me, the general trend here in terms of bipartisan support, in terms of trade action toward China and moving away, that to me is election-proof.
Okay, so again, we speak to CEOs who talk about a more regionalized supply chain. You might supply the US from Mexico or supply China within Asia. And I know that the pharmaceutical sector talking a little bit about that. This adding up to another inflationary impulse, do you think? Or do we manage to do it without it being inflationary?
Well, what's actually really interesting is that while there is clear coordination here from the U.S. and I think the general G7 away from the supply chains, China is doing its best to stay part of that narrative and also stay part of the global goods market, right? They're just actually doing their own domestic manufacturing now. So you see this really in EVs, but also in all sorts of other sectors. And that is a disinflationary impulse. So while I think there is the sort of reshoring narrative can be inflationary over time, China's doing its best to counteract that.
Great to see you. Thanks for stopping by to see us. Wells Fargo's macro strategist, Eric Nelson, joining us on what's happening in this market, top down. Let's talk about the bottom up. This is what the Core 6 looks like this morning. A whole bunch of numbers out that we need to factor into our thinking. But broadly, as you can see, a little bit of a risk-off kind of a day. Nova's soft, LVMH is soft, Ferrari's soft. ASML is bouncing a little bit this morning, but it's been badly beaten up recently. A little bit of defensive tone maybe coming in to Nestle, but I see Reckitt maybe doing a little bit better today. Maybe that's affecting that sector narrative. Maybe the numbers aren't quite as bad there, so maybe that's helping out as well. So in terms of what we're seeing this morning, hard to get a clear kind of steer. I think you probably want to look at some of the other single stocks that we're watching out.
Absolutely. So with that in mind, let's get to Joe Easton. He's got a briefing. Joe.
Deutsche Bank shares coming down around 4%, 4.5% at the open of trading. Now, analysts at RBC pointing to the higher-than-expected loan loss provisions at the German lender, saying that is taking the sting out of those better-than-expected buyback predictions, so weighing on those shares in opening trading. Lloyds, meanwhile, in the UK, the loan loss provisions actually looking a bit better than expected for that one, and Handelsbanken in Sweden jumping following better-than-expected net interest income, something we've also seen from Swedbank today. So a mixed picture, but really Deutsche Bank the main mover on the downside. Deutsche Börse also as well has numbers out today. This is the German exchange operator seeing some weakness in their data business, according to that one. Another one to keep an eye on today. Then in terms of the other earnings we had a focus on, there's a lot in the consumer space today, particularly L'Oreal, which was declining at the open of trading as expected. It was down around 4%. I'm hoping that's going to come up. Well, first we'll go to the UK because we've got Reckitt Benckiser, and now the company announcing some stronger than expected staple goods sales. This is in the household product space, taking some of the weight from those concerns around US litigation, which continues around the infant formula business for that company. And WPP seeing the gains coming through from those new contracts in the US, which some of the big tech firms, including Google, was one of their big firms. So that's firstly, Watches of Switzerland. Now, this one is away from earnings. It's actually an activist investor situation. Gatemore Capital overnight announcing they've taken a stake in the company and is pushing for a US listing of the UK company, potentially going to be the next firm leaving the London Stock Exchange if they do go along with those activist investor pressures, according to a statement. Here's those European earnings. We've got L'Oreal coming down 3% at the moment following that weakness in China. Heineken, meanwhile, Dulux Paint, disappointing analysts. It's the third time they've cut guidance in the past year, and Roche holding up pretty steady following some pretty solid numbers from the pharmaceutical company over in Switzerland today. Just one morning call to bring you Porsche in the auto space. This one upgraded to buy over at Citi that says the sell-off in the sector is potentially overdone for now, and they recommend actually buying Porsche once again, and that stock is rising 2.4% in Germany this morning.
Thank you, Joe. Joe Easton with an equities briefing for you. Coming up on the programme, we'll hear from our interview with Deutsche Bank CFO. Oliver Crook sat down with him and they talked about plans to restart the buyback and also about domestic M&A within Germany, within the banking sector. So we'll certainly talk about that. Our interview with James von Moltke. That's next. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Deutsche Bank shares are kind of jumping around all over the place right now. Let's call it circa down 4%. This after the bank reported third quarter results that actually looked all right. Certainly trading looked good. Advisory looked pretty good. It's the provisioning where I think the problems may lie, certainly from a market perspective. CFO James von Moltke speaking to Bloomberg's Oliver Crook about the results. He was also talking about the domestic M&A story. Of course, we're focused on what is happening with Commerzbank right now.
we've been, I think, pretty consistent in saying the industrial logic for bank mergers makes sense, but that we needed time to be fully ready, and that time hasn't come. And so we're focused on executing our strategy, focused on delivering against promises we've made to our shareholders and stakeholders. And it's sometimes nice not to be distracted by other things and just execute, as I think the third quarter and the year to date showed that we've been focused on execution.
But then I guess, you know, if this were to go through with UniCredit and Commerzbank, it would make an entity larger than Deutsche Bank. We've obviously had consolidation in the Swiss market. We also have BBVA, Sabadell. So this is really a moment for European consolidation. I imagine that makes you sort of reflect on your position, not only within Germany, but within Europe. Where does Deutsche Bank want to, what space does it want to occupy in that landscape, in a landscape that is more consolidated with bigger banks? Well,
let me start by saying we intend to remain number one in Germany, and we think that consolidation here doesn't really change our competitive landscape. Germany is a very competitive market as it stands, and we compete against both Hypovereinsbank, that is UniCredit, and Commerzbank in our home market. So that doesn't change much. But your point is one that we agree with. We think Deutsche Bank is positioned to play a leading role in European consolidation. We think that scale in banking, especially in the regulatory environment we live in today, is something that's important and something we observe again in competition with our U.S. competitors as a strength. So in time, absolutely, we see that. Taking place, and sometimes the first few transactions sort of set off a wave, and I think that's what you're getting at, and we certainly believe that begins.
How does Deutsche stay number one in Germany if that transaction goes through with Commerzbank and UniCredit? I think it's an interesting question. Anyway, of course, that's James von Moltke, the CFO of Deutsche, speaking to Ollie Crook just a few minutes ago. The shares are down pretty hard right now, 4.2%, 4.3% is kind of where we're trading at the moment. Why is the key question? Because broadly, when the numbers dropped on the screen, they look pretty good. I think it's the provisioning numbers that look like they're causing the concern. Ollie Crook's with us now. Ollie, walk us through the numbers and the market reaction and join the dots.
Yeah, that's right, Guy. I think you're right. Basically, you got the nail on the head there. What we saw in terms of provisioning is what is concerning the market right now. They sort of alluded to two large defaults within their sort of portfolio, and that, again, they have not given a lot of clarity on that. And given where we've seen on the provisioning going up, and we saw something similar in the last quarter, that is what seems to be spooking investors now, down almost 5% for what was otherwise, as you mentioned, Guy, a pretty solid quarter. You have FIC. Basically, now Deutsche Bank is the bank to beat on FIC, up 11%. That beat everybody else on Wall Street. Bank of America was the only one that came anywhere close. That was up 8%. Origination and advisory, M&A stuff, up 24%. And again, confirming that they will have a buyback in the beginning of next year because they got a little bit of that money back released from all the huge provisioning they did around Postbank. But I think it's interesting to see the market reaction there now, Guy. And also talking about being number one in Germany, maybe being a little bit too tethered to the German economy. If this is about defaults within some of their portfolio and you have issues in the German economy, is that going to be another concern for Deutsche Bank?
Yeah, so really interesting to see the way the shares are responding then, and the provisioning story that you highlight there, Ollie. Back to the comments that he had to make about consolidation. I mean, you asked him about Commerzbank and whether that sets off something of a wave. He did seem very enthusiastic that Deutsche Bank will play some part at some point.
Yeah, absolutely, Anna. So, I mean, this has really been the question because the focus for Deutsche Bank and Christian Sewing for the last couple of years has really been getting this turnaround on solid footing, and that seems to be kind of the mode that Deutsche Bank remains in right now with all of this consolidation. And obviously, Commerzbank brings it home, but we've had the consolidation of, the forced takeover of Credit Suisse by UBS. We have in Spain, BBVA and Sabadell. All of these conversations, this is a different European landscape going forward. And in the past, when we've talked to Deutsche Bank about this, they said basically until there is a banking union, there is sort of limited upside to what you can do with these acquisitions. That being said, Andrea Orcel is very much going with the build it and they will come, build the bank and the union will come. And does that put pressure on Deutsche Bank in order to remain competitive in what is going to be a landscape with a lot larger banks? And it sounds as if they're not quite ready to sort of move from turnaround to a more aggressive phase, but that could happen beginning next year. They say they want to play an active role in European banking consolidation.
Oliver, thank you. Bloomberg's Oliver Crook there. And on a programming note, we'll be speaking with the German Finance Minister, Christian Lindner. That's at 2 p.m. UK time. Quickly, we should talk about L'Oreal.
Let's do it. One of the biggest German stories, too. One of the biggest French stories. L'Oreal shares falling after those sales missed estimates and a deepening demand slowdown in China. Let's get more from Bloomberg's Angelina Rascoway, who, of course, covers this story well. Angelina, what went wrong in these numbers? Is it just more of weakness in China?
Hi there, that's exactly it. I mean, basically the region that includes China and North Asia was down 6.5% when the markets were expecting it to be positive. So that was a big disappointment. Basically, there are continued worries about the macroeconomic picture in China, consumer confidence, the property market, and L'Oreal. I mean, basically, this was the 5th straight quarter of negative results there in China.
Angelina, is there a sense, though, from the company that with China's stimulus beginning to be announced by the government, that they will be a beneficiary of it?
I mean, they said they're hopeful. Obviously, it's probably too early to say because it was just announced the first initiatives last month, so it'll take time to trickle down. But basically, the company said, I mean, generally the luxury companies that they're not going to give up on China so easily. But they also had issues of their own making. There was also disappointment with their dermatological beauty unit, which includes brands such as CeraVe or La Roche-Posay. And Nicolas Hieronymus, the CEO of L'Oréal, he said that there were some issues, for instance, in CeraVe, worldwide. They probably had a lack of innovation. That's when they don't launch enough products. So it wasn't on top of consumers' minds, especially the Gen Z. And they also had a bad weather season. So that meant that people didn't, who would normally replenish on sunblock and sun care products, they didn't sell that much of those products. So that was a big disappointment as well in that unit, which normally was growing double digits.
And so is this something, Angelina, that should read across to others in the sector, others in the French luxury space, for example? L'Oreal, not always luxury, but are there read across or no?
I mean, we already got signs that beauty and cosmetics was struggling last week with the LVMH. I mean, the unit grew, but it failed to beat estimates. Tomorrow and the rest of the week, we're gonna get Kering results tonight, and tomorrow we're gonna get Hermes. Hermes, they have a beauty unit as well, but Hermes, their biggest division is leather goods and saddlery. So, but all in all, I mean, it follows relatively disappointing results from LVMH beauty unit, but also Coty. So L'Oréal is showing similar signs.
Certainly something we're going to be keeping a very close eye on, and not whether L'Oreal is kind of a canary in the coal mine for what we're expecting to see in some of the other earnings reports as well. Bloomberg's Angelina Rascoway joining us out of Paris to talk about that. We thank you so much. So we did Germany, we did France. Let's talk about Spain as well, because you are seeing some outperformance in some of the stocks there, specifically when it comes to energy stocks. And I think this is interesting. This is coming from a report from a Spanish newspaper, Expansion, talking about the Spanish government considering a reduction in the windfall taxes. This is something that the Spanish government has been trying to make permanent for some time now, at least according to the report. It's an idea here that maybe instead of keeping it permanent, they would instead impose that tax on operating income instead of revenue. This is something that's being talked about in Italy. This is something that's being talked about, of course, in Germany as well. This idea of whether or not windfall taxes are indeed effective to stem some of those deficits. Spanish stocks rallying off the back of it.
It's really interesting. I mean, it seems a little while since we've been talking about these real peak profits and peak energy prices for some of these businesses. If that's what we're harking back to here, maybe politics takes a little while to catch up.
It's going to be a story here in the UK. We're going to watch what happens with the banks. Certainly they look like they're in focus when it comes to the budget that is coming up. So that could be a story. I haven't actually read through the Lloyd's statement this morning. It'd be interesting to see if they talk about that within those numbers. But these kinds of taxes on industries is going to be something that it kind of feels like it's going to be with us for a while. The government bucket is empty. The corporate bucket is relatively full. How do you manage those
Lots of guests talk to us about that, don't they? They say, government balance sheet weak, corporate balance sheet strong. Therefore, there will be some flow.
We'll watch. We'll talk about that next as well. We're going to be focusing on what the other factors around the UK budget are a little bit later on in the programme. What else are we going to be talking about? The IMF boosting growth projections for the UK, but warning the new Labour government needs to keep its eye on that rising debt story. We're going to focus on that story again next. This is Bloomberg.
principles, our policies in support of the Palestinian people will never change. Our policy in having a two-state solution will never change, and nothing will compromise it. And as long as we are, having the capability to be helpful, we will do it. We did that between Afghanistan, between Taliban and the US. We did that between different parties in Lebanon and Sudan and others. And that's basically the core of our foreign policy. It's been built based on mediation, on trying to help in resolving conflicts between the parties. There are countries or people might not like it, but we don't ask everyone to like it, just to understand it.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Minutes into the opening trade, the numbers look a little bit like this. Not really going anywhere in a hurry, maybe a little bit more positive than originally anticipated. It's a single stock kind of a day today. You've got a number of names that are having a disproportionate effect on various markets. Deutsche certainly weighing on what is happening in Germany today. L'Oreal a factor for France. The energy stocks, a story in Spain this morning. UK banks are actually having a relatively good day, which takes me to our next subject. The IMF has lowered its global growth forecast for next year, warning of accelerating risks from wars, trade protectionism, etc., etc. The fund has, though, upgraded expectations for the UK, while cautioning that the new government needs to carefully manage its debt load. Anna Andrade from Bloomberg Economics joins us now. I'm never quite sure why we focus so much on the IMF, but that's kind of a subject for another day. What is it that the IMF likes, and is what the IMF is saying consistent with what you're seeing?
Hi, good morning. So what we got yesterday from the IMF, there's nothing particularly new in it. Essentially, the upgrade to the UK that the IMF did sort of reflects the good news that we've been having since the start of the year on the UK economy. We saw the UK economy growing by an average of 0.6% on the quarter, and that's sort of what leads this upgrade to the IMF now sees real GDP growing by 1% this year, 1.5% this year. That's broadly in line with what we're expecting. There's nothing particularly new. But I think the bigger question, and I think that's also where the IMF pointed in that direction, is what comes after that. Because right now we're seeing this sort of cyclical recovery driven by easing policy rates and also by a recovery in real income, so a recovery in consumption. But after that, and what that will determine the growth in the medium to long term are structural forces like productivity, employment, and investment. And from that perspective, things aren't looking great, nor for the UK, nor for the rest of advanced economies.
In terms of the UK, can the Labour government at the end of the day manage their debt? I mean, I know we're all kind of waiting for that. Do you have any early indications?
Yeah, I mean, the IMF also focused on that because the problem with sort of these low growth prospects that you have both for the UK and for most advanced economies, euro area is included, is that in a context of high interest rates, then the only way to grow your debt to manage your debt is either to take tough decisions like spending cuts and tax hikes, or really grow your economy. And I think the Labour government is very aware that it wants that growth is part of the solution. It has aimed for growth of 2.5% in the long term. Now, that's very high. Our forecasts are more around the 1%. It seems overly ambitious, but that's the right direction to take. And I think this budget that we're going to get next week will be a first test, because on the investment front, at least, it will show us how willing Labour is to sort of put the money where it needs to go. And right now, one way to improve our long-term prospects is to boost investment.
Okay, so growth and investment, one of the themes of the budget. Anna, thank you very much. Anna Andrade from Bloomberg Economics. Another will be fixing the public finances and how it does that, which sources of income it draws on. So the UK's super wealthy are warning that tax reforms proposed by the new Labour government could cause a, quote, second Brexit. One study commissioned by the lobby group Foreign Investors for Britain has found that proposed non-dom reforms may cost £1 billion a year instead of actually raising funds, which is what they would perhaps be designed to do. We're joined now by Leslie McLeod-Miller, CEO of Foreign Investors for Britain, who is hoping, of course, that the government is listening. Leslie, good morning to you. So set out what it is you think the Treasury, the government should do here, some sort of tiered tax regime. Exactly. Briefly explain what that means.
Well, so the Chancellor said that they would only make changes if they would make money and they were practical. And in March of this year, the OBR said that they had based research that would show that we would have a very small number of people leaving, up to 10%. So we conducted further research because the database was so thin, and the government recognised that. So we commissioned Oxford Economics to look at the whole non-dom regime here. And IHT, inheritance tax, was the red line. So preventing inheritance tax from being protected, as it has always been under the former government. And actually, we've had a non-dom regime in Britain since about 1799. So this is a major, major change. And what we say is that people will leave, and not just a number like 10%, but nearly 80% of non-doms would leave. And so rather than raising £3.6 billion for the Exchequer, we would lose up to £1 billion.
Okay, so you're focused on the tax take that this will actually bring about. Yes. And I think we've actually heard from the Rachel Reeves team, they've said this is not ideological, we'll only do this if it raises money. But I'm sure there are many on the left who see this quite ideologically, and they look at IHT and they say, actually, that's a very redistributive tax, and if that's what you're trying to do, they make no apologies for that.
Yes, but you need to be practical. So this is a highly mobile group of people, and they can be anywhere. They choose to be in Britain. And they said that they bring up their families here and they make investments. And this money goes straight back to things like frontline services. Many of these non-doms deal with a whole range of philanthropy as well. Yeah. And they contribute £9 billion of tax revenue to the Exchequer every year.
Does it seem conceptually strange, though, that you can be non-domiciled but live here?
No, I don't think it does, because if you come from a country where there's no inheritance tax and you have generational wealth, why would you expose your generational wealth just because you've chosen to be here? But not just be here as some tax dodge, to be here, contribute to society. And that's why we want to work with government in partnership to find a fair tax system which works for everyone and works for the ordinary taxpayer, because at the moment these non-doms are being courted by Italy, by Spain, and why would you?
Dubai, maybe.
Yes. Why would you want your money to let money go and for it not to be spent in this country?
Just to be clear, when we're talking about inheritance tax, we're talking about assets that are held outside the UK.
Yeah.
Okay. We talk about non-doms. This is a sort of colonial era phenomenon that has existed in the UK for a long time. We probably need something more modern.
We do, and
do we need to rename it? Do we need to restructure it? What would be the ideal outcome?
The whole word non-dom is pejorative anyway, isn't it? And it has connotations of tax dodging. And so we're saying that it does need to be fair. It needs to be a system of foreign investment and recognising that people who are here are making a contribution but need to make a fair contribution. So we're saying...
Is the emphasis that, do you think these people are making a fair contribution now?
No, they're not. And they're also saying that they would like to pay more. And this is why they need to... We've had a meeting with Treasury where Treasury was able to speak directly with non-doms for the first time. And they're saying that they should have a system rather like Switzerland or Italy, where you have a tiered system based upon your wealth. So beginning at, for example, at £200,000 is your base for those with assets up to £100 million, ranging up to £2 million for those with assets of
But this is a group that's not paying enough tax now, but could pay more in the future. What is the delta? What's the spread on that? How much more tax could potentially the UK government raise were it to put into
I think it's
action?
Almost the other way around. How much will they lose? So we believe it's a large number, and we want to model that together with Treasury. But what we are saying is that if the proposals go ahead as they currently are, the government will lose. The British taxpayer will lose.
You made a key point earlier about the non-DOMs being courted by other parts of Europe as well, Italy, Spain, et cetera. But even within those domestic governments, they're also thinking about increasing the taxes to stem their own deficits. How long do you think that edge and that courting could last if the same problems exist elsewhere?
Well, we need a long-term solution, which is why we're looking at 15 years as a stable regime. And people stay here because Britain is stable, but the non-doms are here for a whole range of reasons. It's great for education. It's wonderful for culture, and they like to bring their children up here, and they do. But they want to invest back more. They want to work in partnership with this economy and make it grow. And if the current proposals go ahead as they are, everyone is now saying that this will be a loss. The Growth Commission last week said that we would lose $5 billion a year by 2030 and 0.5% of GDP also. Then we have the Adam Smith Institute that said we would lose £6.5 billion by 2035. So we're all saying the same thing.
And Leslie, has your argument and your proposals around the tiered tax regime and this period of no change for 15 years, are they being listened to? Are you getting a hearing?
We hope so. We have a meeting with number 10 tomorrow. But the alarm bells are here for everyone.
So you get the sense this isn't settled yet?
I certainly hope it isn't settled because there are certain red lines. Inheritance tax is a red line for this highly mobile group of people. It's like the Concordia. If you hit the reef, you go down, and we can avoid that.
So finally, in terms of how you think this is going to play out, the budget's on the 30th. What happens after the budget if you are not listened to? If we are not listened to, we will have to continue to lobby because this government. So you don't just pack your bags and leave. There won't be that kind of a story that develops post the budget.
Well, it would be tragic if that happened after decades of this regime being there. People have their children in school, and also it's not the right thing for the British population to allow this to happen. So we will continue to lobby.
Okay. Leslie, nice to see you. Thanks for stopping by to see us. See how the meeting goes. Leslie McLeod-Mailer, CEO of Foreign Investors for Britain. Thank you very much indeed. Coming up, we're going to talk Tesla. The company is reporting later today. Investors eager to see more details on a potential cheaper car, as well as the recently unveiled cyber taxi. We'll have the latest on Tesla and the car sector next. This is Bloomberg.
biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? Is it just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
AI will bring a tremendous opportunity for this industry. So that's the first thing we have said. So I said on the long term, AI is going to build up a real strong opportunity for the industry. Now on the short term, I think you're aware of that. Not everyone is surfing yet on the AI wave.
Not everybody on that wave, apparently. ASML CEO Christophe Fouquet speaking there at the Bloomberg Tech event taking place in London and discussing the opportunities around AI. One business that has been looking into some of those opportunities, Tesla, is set to report third quarter results after the US market closes today, with investors focused on the EV maker's automotive gross margin and forward guidance. For a preview, let's bring in Bloomberg's global automotive editor, Craig Tudell, who, of course, can help us go through some of this. So let's deal with all the things that are away from the robo-taxi or cyber thing. Let's deal with the numbers.
The here now.
Yes, the here now, and the things they've sold and the things they think they'll sell. What's the talk around that? Because these numbers are watched very carefully.
Yeah, I mean, I think this has become a bit of a harder, a more difficult company to cover if you're an analyst, in part because we've gone back actually to years ago that one of the knocks on Tesla was the only reason they're still in business is regulatory tax credits. We're not in that position anymore where that is, a factor in whether or not the company is sticking around. But this is actually something that's sort of reemerged as a major driver for their financial results because companies have struggled so much to spool up their EV sales. They're introducing more EVs than they did half a decade ago, but they're not selling them. And that is something that even Tesla is feeling in terms of a slowdown in growth for EVs, and it's very much industry-wide. So there was a bit better quarter this past 3 months in terms of demand for them. They had their first deliveries increase in a bit. But in terms of earnings, I think there's some real questions about whether or not they will actually be able to grow earnings because they may have grown sales on lower-priced EVs.
GM had a really good day yesterday. Yeah. Like amazing day. The stock was up kind of 8-9%. The commentary that comes out of it, we remain on track to reach our 24 EV production and profitability targets. We expect a $2 to $4 billion EV profitability tailwind in 2025. Is what GM is saying or said yesterday good news for Tesla? Should I think about this as something I should be factoring into my Tesla thinking as I go into the numbers? How do the two businesses compare?
I think it is. We've talked, year after year about, the competition is coming. The competition is coming for Tesla, and for the most part, I think it was overestimated to what extent Tesla really was facing legitimate competition. I don't think that's necessarily the case anymore. Where you do have some attractive-looking electric vehicles, whether it be out of GM, Hyundai and Kia in the U.S. are really gaining traction. So if you're Tesla, I think it's positive to see this EV trend take hold more broadly for the industry. I think they have very much actually done their bit actually to help with that in terms of in the U.S. Offering their charging network to more of the industry, but it does mean more competition for them in showrooms, and it's showing in terms of real slowdown in the U.S. market for them.
Let's talk a little bit more about that charging network. I'm a little confused about what happens to Tesla regardless of who's in the White House in 2025, simply because on the one hand, you have this massive investment in infrastructure and EV subsidies, which of course Tesla has profited off of. But then on the other hand, you have almost this pullback of those very pieces of support from in a Donald Trump era, who, by the way, has the support of Elon Musk. How are you interpreting these scenarios?
Yeah, it's really hard to square this idea of Elon Musk's support for Trump after all that Biden has done for EVs. And I think, is there some clear factors that come into play here in terms of Biden obviously is very pro-union. Musk has made his feelings about unions quite clear. He does not feel appreciated or even recognized by a Biden administration. And yet, Tesla is one of the biggest beneficiaries, not just of purchase tax credits, but manufacturing tax credits as well, given the batteries that they're manufacturing in the U.S. with Panasonic. And so they would potentially be hurt from the perspective of those tax credits, also from the perspective of support for charging infrastructure. And yet, maybe I guess Musk is sort of viewing this as a big opportunity in terms of maybe he's in the driver's seat in a government efficiency commission that does away with some of the regulators that keep an eye on Tesla.
Craig, thank you very much indeed to our automotive editor, Craig Trudell. I want to take you to Russia, to the BRICS summit, which is taking place in Kazan in Russia. President Xi Jinping of China arriving at that summit. You're looking at live pictures coming from that summit. A lot of eyes on what is happening here. A sense maybe that Vladimir Putin not as isolated as maybe we would think, certainly in the West. This is a well-attended summit, and this relationship between Russia and China critical.
Yeah, absolutely. 32 countries in attendance, a big gathering, one of the biggest they've managed to assemble on Russian soil since the invasion of Ukraine, of course. We had some really interesting analysis by Bloomberg yesterday about the new neutrals, so dividing the world up into Western bloc and then another bloc of Russia and China, and talking about the number of countries that are still in play when it comes to that sort of neutral positioning, and the BRICS clearly going after some of that.
Europe really struggles with this one as well. This is a real issue for European industry. Let's turn back to what is happening on the industrial story. We just talked about what's happening with Tesla and GM. Let's talk about what Boeing's day looks like today. It has already signaled the company a big loss. We're going to get the numbers this morning. So this is the Q3 numbers that are going to come out. We've already had an indication that these are going to be bad. So investors and analysts are now looking to the new CEO, Kelly Ortberg, to lay out his strategy. This is his debut earnings call. The problem with that is that later on today, we've also got this union vote that is going to be determining whether the strike at Boeing continues or ends today. So let's talk to Benedict Campbell, who leads our global aviation coverage. Benny, how big a day is this for Boeing?
It's pretty huge, I would say. It's going to be 24 hours of fun. We will get, as you said, the numbers first. And more crucially than the numbers, we'll get Kelly Ortberg's first sort of strategy update. He will lay out how he sees the future for Boeing, how we got here, what needs to be fixed, and where the company goes from here. And arguably, as you said, we've had the numbers. That's going to be in focus. People will want to sort of delve into his strategic vision, what he plans to do, and maybe also what he doesn't plan to do going forward. We got a bit of a taste of that a couple of weeks ago when they announced the job cuts. And there was a slightly veiled message in there that Boeing can't be everything to everyone. We need to think about where the core of Boeing lies, what we can do, and that might signal that the Boeing that we'll see in a couple of years will be a slimmer, a more focused company that has probably gotten out of some businesses. So we'll probably get the first contours of that today, and the messaging will be far more important than the numbers.
Yes, and how on earth do you get the messaging right, Benny, when you've got to put messaging into an earnings release for a start, and then you've got to talk to investors, and you still don't know perhaps some of the details of what you're really dealing with? I mean, how's that task going to be undertaken?
Well, that's going to be very difficult indeed, because he's delivering this with sort of one arm tied behind his back. We won't know until late in the day what the outcome is from the workers' vote, whether they will indeed ratify this latest tentative agreement that's out there. It's a 35% increase in wages. So we've come about 10 percentage points from the original offer, but a lot of people online still saying that's not enough, we need to see more, we want our pensions back. So there's still a lot of resentment and anger lingering from previous agreements that workers felt they were shortchanged. So we need 50% plus one to get this over the hump today, and it's anyone's guess whether they'll get there or not. If indeed, it would be a huge boost for Ortberg, because it would really help sort of get one major stumbling block out of the way. If it fails yet again, they're back to kind of square one. They have to renegotiate. It'll seep arguably into the US election, so there'll be that political component, and we're looking for a longer recovery for the company yet.
Benny, is there a read-through to some of the other kind of big names in the space in terms of the industrial read-through? Guy and I were talking about that earlier on the show as well, but also in terms of Airbus, in terms of the way it trades, is there a ripple effect, or is this isolated to Boeing?
Well, you know, nothing that Boeing does is isolated to the company, because they are such a sort of central part of the industrial, of the aviation complex. Essentially, you have these two companies dominating this space. You have Airbus and Boeing, and Airbus have issues of their own. Let's not, you know, sugarcoat that, but they're not as pronounced as those facing Boeing. Airbus will have their earnings next week, so we'll get a little bit more of a read from them. But really, the big issue, and that's the ripple effect over to the customers, is they're not getting the planes that they want. Production at Boeing is pretty much at a standstill when it comes to the 737 and some other planes. The only one they're really producing is the 787 at the moment, but even that one in low numbers. And that's a huge issue for the plane maker, for the airlines. They're flying older kit. We're seeing airlines like Lufthansa being forced to cancel some routes because they have to fly them on old aircraft that are so inefficient that it's no longer viable. So you're seeing that real world effect on the space. You're seeing it with suppliers, Spirit following employees, Senior in the UK also cutting jobs. So it's really wherever you look, you have this ripple effect, and that really puts into stark focus the task ahead for Ortberg, the CEO.
All right, Bloomberg's Benedict Campbell leading our global aviation coverage with a pretty exciting, I'm sure, 24, 48 hours ahead of him. We, of course, will keep you apprised of all those developments. Another exclusive conversation to look forward to right here on Bloomberg Television is with LinkedIn CEO Ryan Roslansky. That coming up at midnight UK time. You can find that, of course, right here on Bloomberg Television, and certainly keep an eye on that. In the meantime, we do have some live pictures going back to the BRICS summit over in Russia. We did just see moments ago Xi Jinping, the Chinese world leader, arriving. Now it looks like they are standing for that family photo, including the likes of Narendra Modi as well out of India, and I believe 32 other nations attending this morning.
BRICS membership has really expanded, with more states seeking to enter this grouping. So we'll continue to monitor headlines coming from that. We're also going to be monitoring a whole host of other things in the markets today, including some data out of the United States. Christine Lagarde speaking in Washington. We heard from her yesterday in our conversation Francine Lacroix was having. And we'll hear from Andrew Bailey. He's speaking in Washington. It seems higher R* was the message we got from Green. She was talking about how we settle at a rate of inflation that is higher than it was previously.
Yeah, and we can expect, therefore, higher rates to be the narrative that spins off that as well. How dovish will Bailey be? Interesting in light of the fact that the Fed is taking a tougher tone. Does he reflect that as well? The UK is kind of caught in the middle at the moment.
That is it for the opening trade. The Pulse is up next. The Stock 600 is pretty flat. So the FTSE 100 and the IBEX just keeping themselves in green territory, but everything else dropping just a touch. US futures pointing a little lower. Have a good day, everybody. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
The bond sell-off continues as investors bet on a slower pace of US rate cuts. The dollar gains against all G10 peers. Bank of America's chief Brian Moynihan urges the Fed not to go too hard on rate cuts in an exclusive interview with Bloomberg. Plus, McDonald's shares slide after its quarter pounders are linked to a severe E. coli outbreak in the US. At least one person has died, with nearly 50 falling ill. Let's check in on the markets. The earnings story is front and centre for us, and the adjustments around the thinking of the central banks. There is divergence now on these bond markets in terms of what you're seeing with US Treasuries versus European debt. Think at the front end of the German debt curve and also Italian BTPs as well. I'll give you more details on that in the seconds ahead. The UK is currently just up 0.1% on the FTSE 100. You're down about 1/10 over in Germany on the DAX. Deutsche Bank is lower, despite the fact that on the top line it beat the concerns around provisions. The CAC current over in France currently down 0.4%. Let's flip the board and look cross-asset then. Yes, the moves, higher yields in the US remains the story. 421 right now on your benchmark 10-year, but it's a very different story, as I mentioned, in terms of European sovereign debt, with a move into the front end. Yields down 5 basis points on the German 2-year at 2.12. Euro dollar at 107, a little softer in the session, down 0.1%. Brent 75.55, down 0.6. The inventory build-out in the US, a reminder that maybe there's further softness to come for this oil market, with a continued focus, of course, and the dynamics of the Middle East and the conflict in that region. The conversations that matter, the insights you need to know, getting started in the next few seconds. Stay with us.
Newsmakers and market movers. This is The Pulse with Francine Lacroix.
Good morning and welcome to The Pulse. I'm Tom McKenzie in for Francine here at our European headquarters in London. We check in pre-market on Qualcomm on the story that ARM has pressed arguably the nuclear trigger on their debate over and their conflict and disagreement with Qualcomm over intellectual property and licenses, ARM threatening to scrap a license for Qualcomm. They've gone ahead with that. They have a period of time, Qualcomm, to respond. This is linked to a license that would allow and allows them to design particular chips. The disagreement goes back some time, but Qualcomm pre-market down at 5.3% on the back of the news that ARM plans to will be cancelling that chip design license, again, in a major escalation of the dispute between these two major players in the semiconductor space. So we'll keep an eye on the Qualcomm story for you, of course, through this day. Now, Blackstone CEO Steve Schwarzman says the US is likely to avoid a recession regardless of who wins the presidential election, as both candidates have policy proposals that drive growth. Joining me now is Kieran Ganesh, a multi-asset strategist at UBS Wealth Management's Chief Investment Office, for a deep dive on these markets. And we'll start then on US politics. Kieran, thanks for joining us. Do you want to lean into the Trump trade that has suddenly come back to the fore in recent days?
Well, we've certainly seen a strong rally in a lot of companies that would likely benefit under a Trump administration, and that has gone in line with the increase in the probability of Trump winning, both in the polls and in the prediction markets. We would be a bit more selective about, who are some of those potential winners, though. We like the financials in particular because while there is still uncertainty about the election result, we don't think they're fully pricing in a potential deregulation outcome which could come under a Trump administration. In contrast, of course, they may face higher regulation under a Harris administration, but we think that given where valuations are, they look like an attractive play. So we're leaning into the financials. Utilities is another area that we like in the US that could benefit from higher power demand as well if the economy remains strong. So we're being a bit selective. Advising investors not to make too large swings based on an election outcome because, of course, there is still a lot of uncertainty, but we do see upside for markets regardless of who wins.
Okay, that takes me on to the broader question, actually. So you favour financials, you favour utilities. You step back, though, and your advice to clients would be stay invested despite the expected volatility around this US election. Is there not a case, Kieran, to be putting some money, parking some money on the sidelines until we have more clarity on the US political scene?
Well, I think if you look historically, markets have tended to rally both into and after US elections, and it's been sitting on the sidelines, which has been far more costly than variations you might get based on who might win. And if we look at the bigger picture with the Fed cutting interest rates, even though the economy is doing very well, that tends to be a very positive force for markets. If we look historically, you've seen 15 to 20% returns over the next year when we've had that dynamic. So we think it would be a bit unfortunate if investors, out of fear of the election, are missing that bigger trend, which is lower interest rates and a strong economy, which is supportive of equity markets.
Kieran, we're seeing a repricing in the bond market. Do we expect to see a repricing in the equity market?
Well, bonds have been selling off, in part because of that stronger growth, in part because of some repricing for the Fed. And when we look at equities, that same economic growth is driving really substantial growth in corporate earnings. I mean, we've seen just over the past 4 or 5 years that US corporate earnings have doubled, and we're expecting to see another 11% earnings growth this year, high single digits for next year as well. So that earnings growth, we think, will continue to power markets higher. Of course, if yields do start to move significantly higher from here, if the Fed is forced into re-hiking interest rates, then that would be a more negative picture for equities. But we think that the dynamic today of inflation coming back towards the target, rates coming down, and the economy remaining strong is pretty much a Goldilocks environment for stocks. And we're looking for the S&P to hit 6,600 by the end of 2025. So that's around about a 15% return from where we stand today.
Okay, up 15%, end of 2025, 6,600, I should say, on the S&P is the target, is the forecast by the end of 2025 for you and the team. Is, for the here and now, at least the upcoming Fed meeting in November, if they pause, as the likes of Torsten Slok suggests at Apollo, are the equity markets at least vulnerable to that scenario?
There will be some volatility, and I think we do need to expect that in November. Uncertainty about what the Fed might do. The election will lead to some volatility. I think that's for sure. I think the key point for us is that investors should be using that period of volatility to think about how are they going to deploy cash that they have on the sidelines for the next year and the next years ahead. So that's where we are focused on equities. I talked about financials and utilities, AI stocks, which may face any volatility around that as well, we think are interesting. So using periods of volatility to deploy capital into those areas, as well as into some high quality bonds, which we like at the shorter end of the curve, and we think is what investors should be thinking about as we head towards the end of the year.
Okay, Kieran, let's take a listen to the ECB President Christine Lagarde, who's been speaking, of course, to Francine Lacroix on the outlook for inflation. Let's listen into the soundbite, and then we'll get your views on how to position in Europe.
I think we are all confident that 25 is the year when we reach our target on a sustainable basis and with the medium-term caveat that I have mentioned. But we have to be attentive to everything.
Okay, so the ECB head suggesting that they are making progress towards that 2% target. There will be further cuts from this European Central Bank. How do you factor that in when you're thinking about exposure to Europe, Kieran?
Well, I think the ECB is probably approaching the inflation target a bit faster than they might like, actually, because we're seeing clearly greater signs of disinflation in Europe than in the US, and the economy generally performing weaker in Europe than in the US. Nonetheless, that does give the ECB the flexibility to start cutting interest rates, and that should be a supportive factor for equity markets in general, and we are looking for upside for European equities in general. I think the question when it comes to Europe is, are there the high quality companies that are going to really capture some of that structural and secular upside you're getting from some of these big trends playing out in the world at the moment? And the answer to that, unfortunately, is not so much. So that's why we tend to focus more towards the US, because you've got those higher quality companies. And where we do see some opportunity in Europe is in the small and mid caps, because they would be quite exposed to lower interest rates. Of course, they are reliant on bank lending, and if interest rates do come down, that should be positive for their profitability. So small and mid caps is a focus in Europe.
Okay, small and mid caps in Europe, a target of 6,600 for the S&P by the end of 2025, with a tilt maybe to utilities and financials, with US politics maybe a factor as well in the months ahead. Kieran Ganesh, thank you very much indeed for the analysis from UBS Wealth Management's Chief Investment Office. Now, a severe E. coli outbreak tied to McDonald's Quarter Pounders has made dozens of people unwell. You can see the pre-market move on the back of this story, down 6% after the losses as well. It came through yesterday. Pre-market down 6%. Now, these cases mainly in Colorado and Nebraska. One person died as a result of this, is what we're hearing. That's according to the U.S. Centers for Disease Control and Prevention. So there's, of course, the impact on consumers, and then the impact on the stock itself. Let's bring in Bloomberg's Kriti Gupta, who's been looking at the story for us. What is the latest, Kriti?
Well, I mean, you outlined some pretty scary stats there. And, of course, you are seeing the CDC and the entire McDonald's sphere really try to address this problem at the core before it spreads largely. That does include looking at some of their suppliers. And it looks like they've narrowed it down to one onion supplier specifically. They've come out and said, look, these are the other burgers that are not actually affected by this. The running against, of course, the precedent that some of the other fast food chains have set, which is like Chipotle, for example, in 2015, or Wendy's prior, because especially in this region, affordability of McDonald's is something that is key to the company. So suddenly, if this is something where you do actually lose customers and lose the appeal of that, it is hard to win back those customers. And this is really where McDonald's is kind of racing the clock here in terms of putting that Quarter Pounder, which, by the way, is a very popular item for them, back on the menu, and really kind of erasing some of the damage this has done in people's minds.
Is it important to think about where the location in terms of the states where this happened, and obviously in terms of McDonald's, they've been in the news as well in terms of their links, at least Trump using one of their venues in his election campaign. Tie all of that together for us.
Yeah, I mean, they seem like two separate stories, but this is where I think the cultural component is so important here, with that McDonald's, one, because of its affordability, but two, because it is seen as kind of this quintessential American meal that every maybe kid has growing up, especially in a part of the country that is away from the coast. And this is why this outbreak is so important, because it's coming in part of the country which is kind of west of the Midwest, if that makes sense, so kind of Colorado and the states around it, where, again, that affordability question is so crucial. So this dynamic of really appealing to mass voters or mass America is less consequential on the East Coast or the West Coast and more in the Midwest, which is again why McDonald's is racing against the clock, but also why you've seen the likes of Donald Trump and Kamala Harris, by the way, who has worked in McDonald's prior, really addressing this audience because it is seen as such a kind of stalwart of American culture.
Right, very interesting. What's happening on Starbucks? Because they just seem to have problem after problem in the US, but also in China.
Yeah, it's interesting. I mean, they seem like two separate stories as well with McDonald's and Starbucks, but I could argue that these are two companies that have a lot of exposure to international markets. You see that in the McDonald's index. I think The Economist used to have the Big Mac index to talk about currency exposure. Well, Starbucks has the same issue. They're trying to get bigger abroad. Apparently, people abroad don't have the same appetite for sugar that Americans do. Surprise, surprise. But you are seeing them suspend their 2025 guidance. A lot of that really pointing to expansion efforts in China that have not fully paid off. But then they talked about weakness in the American consumer as well. You're starting to see the issues that you've seen in Europe and in China start to seep into the United States as well.
Yeah, and you know, they have real competition in China as well with some of those homegrown efforts as well in terms of the Chinese startups in the coffee space. Kriti Gupta, thank you very much indeed. And you can see the pre-market move there on Starbucks as well. Two crucial stories for us on the corporate front today. Talking of the earnings story, coming up, Deutsche Bank plans to restart share buybacks after strong revenue in its investment bank and settling a legacy dispute. We're going to discuss that next. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
We spent some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything. Earnings season is here.
Once again, we find ourselves asking whether the earnings season can live up to expectations.
Bloomberg is first to break the numbers.
Just crossing the terminal, we have results from Heineken.
We're getting SoftBank out. Glencore numbers are dropping as well.
I'll quickly mention Diageo because those numbers are coming out.
Smashing the estimates.
With the smartest insights.
What are you most looking forward to the second half of the year?
We've lifted the margin guidance for the year, so it's going to be good.
We will, of course, be bringing all the details.
Continuing coverage on Bloomberg.
So we've got to get back in line. And so they're on that path. They were late to the game. They got to make sure they don't go too hard now. And that's what they are all trying to figure out watching the data.
And that was Bank of America CEO Brian Moynihan speaking exclusively to Bloomberg in Sydney. Let's cross over to the European banking space right now, where Deutsche Bank's third quarter revenue from fixed income securities and currencies rose 11%, outperforming its peers. The German lender also plans to restart share buybacks next year. Despite that, as you can see, shares are down this morning, a little over 3%. Let's dive deeper into this story then with Bloomberg's Oliver Crook in Frankfurt. Ollie's been speaking to the CFO of the bank. Ollie, what were your key takeaways then from the results?
Yeah, so listen, Tom, I think that one of the key takeaways, at least for the investors, has been is a lot of questions around the provisioning and some of the increased provisions that we got from Deutsche Bank. A little bit of ambiguity, frankly, as to what that was all about. They said that there were a couple of defaults in their portfolio, and that is what was sort of leading them to up their provisions, which, again, appears to be what the market is focusing on today, with shares trading down about 3%. But as you say, Tom, overall, this was a fairly positive quarter in terms of the actual results. FIC up 11%. That becomes the bank to beat in terms of all of the reports that we got out of the U.S. Bank of America was the only one that came anywhere close to levels like that of FIC, and that was only 8% growth. And also their origination business and advisory business up 24%. So those were all sort of positive. And again, also confirming in that interview that they will begin a buyback early in 2025, and that is after they got some money back from the provisioning that they'd put aside for this post-bank litigation, which, as we know, is still ongoing. We just had a ruling from that, which has sort of been priced into the stock, which has really not been moving things, but those are really the takeaways from the numbers themselves.
And Ollie, look, you've been speaking to the CFO, von Moltke, of course, and one of the subjects you touched on was, of course, M&A in not just the German banking space, the European banking space. You put to him that question around Commerzbank building out that stake, or UniCredit building out that stake, I should say, in Commerzbank. Give us some details in terms of the colour. What was the kind of response that you got from the CFO of Deutsche Bank, and what seems to be an emerging theme now?
Yeah, absolutely. It's an emerging theme and is really brought home because this is just down the street, Commerzbank, right? And UniCredit coming in and trying to sort of purchase it against sort of the apparent wills of the German government and Commerzbank itself. And obviously this will bear on Deutsche Bank's strategy and really force them to evaluate what space they want to occupy, both in the German market but also in the European market going forward, if this is going to be the sort of story of consolidation. So I put it to him, to James von Moltke, the CFO of Deutsche Bank, in terms of how it's bearing on their strategy. Have a listen.
We've been, I think, pretty consistent in saying the industrial logic for bank mergers makes sense, but that we needed time to be fully ready, and that time hasn't come. And so we're focused on executing our strategy, focused on delivering against promises we've made to our shareholders and stakeholders. And it's sometimes nice not to be distracted by other things and just execute, as I think the third quarter and the year to date showed that we've been focused on execution.
But then I guess, you know, if this were to go through with UniCredit and Commerzbank, it would make an entity larger than Deutsche Bank. We've obviously had consolidation in the Swiss market. We also have BBVA, Sabadell. So this is really a moment for European consolidation. I imagine that makes you sort of reflect on your position, not only within Germany, but within Europe. Where does Deutsche Bank want to, what space does it want to occupy in that landscape, in a landscape that is more consolidated with bigger banks?
Well, let me start by saying we intend to remain number one in Germany, and we think that consolidation here doesn't really change our competitive landscape. Germany is a very competitive market as it stands, and we compete against both Hypovereinsbank, that is UniCredit, and Commerzbank in our home market. So that doesn't change much. But your point is one that we agree with. We think Deutsche Bank is positioned to play a leading role in European consolidation. We think that scale in banking, especially in the regulatory environment we live in today, is something that's important and something we observe, again, in competition with our U.S. competitors as a strength. So in time, absolutely, we see that taking place. And sometimes the first few transactions sort of set off a wave, and I think that's what you're getting at. And we certainly believe that begins.
And so, Tom, what I think is interesting here, and a shift from what we've heard from James von Moltke and Deutsche Bank in the past, when I've asked them about this consolidation in the sector, they said that before there's a banking union in Europe, there's sort of limited upside. What Andrea Orcel is doing with this bid for Commerzbank is sort of the concept of build it and they will come. Build the bank and the union will come, and that is forcing Deutsche Bank to really rethink how they're going to go about consolidation in the future.
Yeah, look, Ollie, another topic that clearly is top of mind for a number of corporate executives, wherever you are in the world, is US politics. Did he have anything to say on the US election?
Yeah, listen, I think there are 2 points to make here. The first is about trading and the revenue. When you have a very volatile time, they expect that the volatility around the U.S. election to really help that side of their business. But I think when you look on the sort of fundamentals and you look at the German economy and a lot of the companies here in Germany, they are very dependent on the U.S. economy. Now the U.S. has overtaken China as the biggest trade partner with Germany. If you get 10% tariffs, that will have a material impact.
Bloomberg's Oliver Crook, thank you very much indeed. Now, from Germany's biggest bank to the wider economy, we're going to be talking to the country's finance minister, Christian Lindner. That's at 2 p.m. London time today. Coming up, Roche shares are higher after topping sales expectations more than a year into the overhaul of its research and development units. More on our interview with the chief executive. That's coming up. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Or other authorities.
Could face bigger challenges next.
Fed was going to keep rate World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Welcome back. Let's check in on some of the market movers and some of the stock reaction on the back of the earnings that have come through thick and fast, of course, this Wednesday for you. L'Oreal with a miss, and you can see the impact there, down 3.8%. Akzo Nobel, the paint maker. Top line, it was a beat. Investors, though, disappointed, and you can see the drop there. Roche Holdings currently flat, and Fuel, maker of bike racks, there you go, currently surging up 11.9% on a beat when it comes to their earnings. Plenty more coming up in terms of chips. Stay with us. This is Bloomberg.
times in tech are on Bloomberg.
A large number of countries are subsidizing their regional data centers so that they could become able to build out their AI infrastructure. They recognize that their country's knowledge, their country's data, digital data, is also their natural resource. Not just the land they're sitting on, not just the air above them, but they realize now that their digital knowledge is part of their natural and national resource. And they ought to harvest that and process that and transform it into their national digital intelligence. And so this is what we call sovereign AI. You could imagine almost every single country in the world will eventually recognize this and build out their AI infrastructure.
Nobody covers technology like Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Good morning, welcome to the Pulse. I'm Tom McKenzie in London. These are your top stories. The global bond sell-off continues as investors bet on a slower pace of US rate cuts. The dollar gains against all G10 peers. Bank of America Chief Brian Moynihan urges the Fed not to, quote, go too hard on rate cuts in our exclusive interview. Plus, McDonald's shares fall pre-market after its quarter pounders are linked to a severe E. coli outbreak in the US. Now, Bloomberg has learned that ARM is cancelling a license that allowed Qualcomm to use its IP to design chips, escalating a legal dispute that threatens to disrupt the smartphone and PC markets globally as well, if it comes to that. The move ratchets up a legal fight that began when ARM sued Qualcomm for breach of contract and trademark infringement back in 2022. Let's bring in Bloomberg Intelligence litigation analyst then, Tamlin Basin, for the details on it. How did we get to this point, Tamlin?
Yeah, well, Tom, we got to this point back when Qualcomm decided to acquire Nuvia. This was back in 2021. Now, Nuvia had a license from ARM that allowed it to customize its architecture. It was trying to get into the chip market for PCs and servers. Qualcomm purchased Nuvia, and after that, ARM said, well, we don't like you using the terms of this license that we granted Nuvia. You can assume that that was at a lower rate than it charges to Qualcomm, its biggest customer. It tried to terminate the Nuvia license, and then it additionally sued Qualcomm for breaches license, saying even the chips that were designed on that Nuvia license, you can't use to continue building chips. So that's why we had the lawsuit in 2022. And as you said, this is an escalation. This is kind of the escalation of all escalations. This does really threaten to roil the entire chips industry. We still believe that this probably leads to a settlement. There is a trial upcoming later this year between these two parties.
Okay, the escalation of all escalations. So someone's got to blink.
Someone's going to blink, absolutely. And right now, we see the move that was reported by Bloomberg as really a move by ARM trying to gain leverage in advance of this trial. Now, these parties, they filed motions for summary judgment. We're still waiting on those to come out. But really, we see this as them trying to gain leverage in advance of that trial.
It's a reminder as well of the complexities when it comes to the semiconductor industry and disputes over intellectual property, and this goes back decades, doesn't it? I mean, ARM saying that they need to destroy some of their earlier designs, it seems, for Qualcomm. Just in terms of the broader market impact then, so outline for us how this plays out in terms of legal terms in the next, say, 60 to 90 days, and then maybe the broader market impact if it isn't resolved.
Sure. So I think this will play out is if the reporting is correct. What's going to happen is most likely Qualcomm's going to file some legal notice saying that actually no, most likely our contract terms are not going to allow you just to withdraw the license. Now, this is unfortunately going to be litigated all in terms that are probably not going to be disclosed on the court docket. So a lot of this is going to be negotiations playing out sort of behind screens and redacted filings. But what's going to happen is there's going to be a fight within the legal fight over whether ARM is going to be allowed to withdraw this license. This is all continuing to lead up to this December 16th beginning of the trial date. Now, in terms of the broader impact, this of course doesn't just impact Qualcomm, this impacts all of Qualcomm's customers. So this does have potentially profound ramifications for the entire chips industry.
Okay, really smart analysis, Tamlin. Thank you very much indeed. Tamlin Basin from Bloomberg Intelligence litigation analyst on the details around this continuing dispute that's escalated, as he was describing. We'll count down to that court trial then and the case set for December the 16th. Now, to US politics, the New York Times is reporting that Jamie Dimon privately told associates he supports Vice President Kamala Harris and would consider a role in her administration. The paper adds that Dimon will not express his support in public over fears of blowback. And Donald Trump has promised tax breaks for car purchases, but only for vehicles made in the US. Trump did not specify whether the tax breaks will be available to many foreign-owned car makers who produce millions of vehicles in the US, including VW and Toyota. In addition to tax breaks for car buyers, Trump has pledged to impose steep tariffs on cars and other products made in Mexico, China, and other countries. And in more Donald Trump news, the former president has accused UK Labour Party members of, quote, blatant foreign interference for campaigning for Democratic presidential rival Kamala Harris. Let's get more on this story now with Bloomberg's EMEA News Director, Ros Matteson. Ros, how do we get to the point where Trump is taking potshots at the Labour Party over election interference?
Well, it's all part of the messaging that Donald Trump is really giving to his core supporter base with, only a few weeks left to the US election. And that is this idea that there's all these groups and sort of campaigning against him from the outside and working against him from the outside. And the latest one, as you say, is in fact the UK Labour Party for what he says are illegal campaign contributions to Kamala Harris. And this is actually a practice that is really, really common around the world, not just in the UK and the US, but many other countries and many election campaigns, and that is that parties send campaign workers over to another country during an election campaign to work on a volunteer basis for those campaigns. They cannot be compensated, and the idea is they watch and learn from those campaigns. They see what works, they see what doesn't, they bring that back to their own country. So it's entirely normal practice. And in fact, Steve Bannon on the other side of the coin in the US has often had, entities set up to have people come and watch elections and work on campaigns in Europe for the far right, for example. So again, it's entirely normal. But for Donald Trump, it is a way to, again, raise that point with his support base and with voters saying there are lots of forces outside the US urging against him and campaigning against him.
And I guess from the UK perspective, a key question is to what extent this damages the relationship between the UK government and a potential new president of the United States, Donald Trump, if he wins in November. What have we been hearing from Keir Starmer, our Prime Minister, in response to this?
Well, Keir Starmer is saying it won't affect the relationship. In fact, he did meet with Donald Trump only last month for a couple of hours in the US. He says he'll work, obviously, with whoever is president, but it may not be as simple as that because we know that Donald Trump is a very transactional person. He also is, very much personality-based. It depends how much he gels with someone one-on-one. We saw that he did have that relationship with the former UK Prime Minister, Boris Johnson. He didn't have it, for example, with Theresa May. And so again, Keir Starmer and Donald Trump are two very, very different personalities. Can they form, that rapport that Donald Trump tends to lean into? At the same time, Keir Starmer is a pragmatic individual. He's had a lot of years of practice at this. Maybe he can navigate that relationship. But really, for any leader, if Donald Trump becomes president, the reality is that he views all countries, allies and adversaries alike. He views them as competitors. And so that relationship will become more fraught, at least on the trade front, either way.
Yeah, potentially a topic or at least a discussion point or something to adjust to for many global leaders if Trump wins in November. Bloomberg's EMEA News Director Ross Matheson, thank you very much indeed for the update. Coming up, ECB President Christine Lagarde says she sees a clear direction for rates, but the pace of cuts is yet to be decided. More from our exclusive interview next. This is Bloomberg.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Welcome back. Happy Wednesday. I'm Tom McKenzie in London. Now, in a wide-ranging interview at the IMF meetings in Washington, ECB President Christine Lagarde has spoken exclusively to Bloomberg about inflation, rate cuts, and Donald Trump's comments on tariffs and the Fed.
At the moment, we are not totally unhappy with what we see, because it looks very much that inflation is on the right track of disinflation. You know, we come from very high numbers, as high on average for the whole of the euro area as 10.6%. And the latest reading we had for the inflation in September was 1.7. So, you know, those numbers are relatively reassuring. They are only a number, and we're not looking at one data point, as I have said repeatedly. We're looking at a lot of data to make sure that this disinflationary process continues to be well on track. But, you know, we also have to be cautious. And you know, we cannot jump to conclusion that, okay, done deal, we've broken the neck of inflation. No. And I think caution leads us to look at all the data that are coming in, whichever form it takes, whether it's survey indicators, as we had a lot of that in September, or whether they are more model derivated as when we have projection exercises. And we will be looking at that and continue to be data dependent, but of course, cautious and not jumping to conclusions.
So when you look at inflation, could you achieve your target a little bit earlier than expected?
That would be my hope. You know, if our target is 2% medium term And I'm absolutely confident that we will reach that target sustainably in the course of 2025. Is it going to be early in 2025? Is it going to be very late in 2025? I think it really will be determined by data, by the state of the economy, by energy prices, by the transmission. You know, we look at three components. We look essentially at inflation outlook, we look at underlying inflation, we look at transmission of our monetary policy. And on the basis of that sort of three pillar analysis, we can assess whether we are definitely on track and when.
I was going to ask you, so we recently had an interview with a U.S. presidential candidate who said tariffs was his favorite word. I imagine because of also your background, former IMF, former trade minister, this is not your favorite word. What is your favorite word?
I think fair trade is a key boost for growth, for employment, for innovation, for productivity. And I would say that it's something that we should not throw away, because in any period of time where this country, the United States, has thrived, were periods of trade, not periods of I'm going to retire behind my boundaries and play at home. No.
I mean, there was a big UK media outlet that called the U.S. economy the greatest economy on earth right now. I mean, would you agree with that? Where does it leave the rest of the world?
I think it depends where you are on the social ladder. I think you have to go further than look at the sort of aggregate numbers or the average numbers. It depends on where you are on that ladder. If you are at the bottom of the ladder, if you are, if you have small job, not much by way of income, I'm not sure that you think of, being in the first and best economy in the world. So everything needs to be considered. But it's a case that the US, for instance, has very high productivity, has a very vibrant tech sector, and has had it for a long time. So it has capitalized on it since the beginning of the 21st century. And that there is a lot of catch-up taking place at the moment. But I think you cannot look at that in isolation. You have to look also at the people. And I think if you look at the Gini coefficient, which is probably not the best way to measure inequality, the US is not doing so well from that perspective. So it's also a question of spreading and distribution so that all people can benefit. Sorry, I'm being political now, forget it.
But do you worry about central banks being political or being dragged into the political sphere?
No, because I think there is a huge resistance to that in the decisions that we make, despite what is being suspected here or there in any place in the world. And I think for those central banks which have the privilege of independence, either by virtue of the treaties or the tradition, it's critically important to hang on to it and to defend it, because the credibility of an institution like a central bank really is a factor of how independent it is vis-a-vis the politics. And it's precious. It's very precious.
But do you think that you'll come under attack more? Not you personally, but just central banks. Donald Trump said, Jay Powell had the easiest job because it's a flip of a coin every month.
He should come and visit us. And I have thousands of hardworking people, economists, jurists, computer scientists, and I can assure you that they work super hard every day, not just once a month.
Okay, not necessarily the easiest job in the world. ECB President Christine Lagarde speaking exclusively to Francine Lacroix, of course, at Bloomberg. Let's bring in Bloomberg's Valerie Teitel right now to dive deeper in terms of what is top of mind for Christine Lagarde, the ECB. She seems, Valerie, pretty convinced they get to that 2% target next year. She didn't give an exact time frame, but it lands next year, and she's pretty confident of that.
Yeah, disinflation is on track to hit their target next year. She didn't give a date, as you mentioned, but she did point out the one thing that does worry her about inflation, Tom, and that is the services component of inflation, the stickier parts of inflation that can be driven higher by gains in wages, for example. And I just want to show here on this chart, this yellow line here is how services inflation has fared over the last few years. And you can tell in the last 12 months, there really has not been a lot of progress in terms of services inflation falling further. So that's a key thing on her mind. It was something she told us last Thursday at her press conference after the decision as well. So the market is going to be focused on this sticky component. But Tom, you could argue that the market is already pricing in the fact that the ECB will have to act more aggressively in the future. If you switch on to my next board, I'll just have a quick discussion on the euro. We have seen the euro weaken over 3% now in the last month. It's on track to weaken, 0.7%, nearly 1% in just the last 3 trading days. We're now under the 108 handle. A lot of this is due to the fact that the market isn't waiting for Lagarde to say that she needs to act more aggressively. They are going to do it for her. We are now seeing a significant chance that she's going to have to deliver a jumbo cut when it comes to the ECB's December meeting. If you flip onto my next board, you can see the rally we're seeing in the front end this moment. We did hear some dovish comments after Lagarde spoke yesterday, notably from Villeroy, governing council in the ECB. He said the downside risks to inflation and growth are significant. So we've been pricing in perhaps a more aggressive path of cuts from the ECB. A lot of that played out in the front end this morning. We're seeing yields 5 basis points lower in the 2-year yield in Germany.
Valerie Teitel, our markets reporter, thank you very much indeed. And I'll reflect on that as well, because we are seeing a divergence. We've been talking about the global bond sell-off, but actually it's a bit of a divergent picture because the sell-off continues, as you can see, for US Treasuries. That's the front end, the 2-year that you're looking at the top of the screen right now at 4.05. Yields up again around 2 basis points. Gilts here in the UK also seeing a little bit of selling pressure, and you're seeing that across from the 2s, the 5s, the 10s, all the way to the 30s with a 33 basis point move higher in terms of the 30-year gilt. But it's a very different picture, as you can see, when it comes to those sovereign debt stories of Europe. As Valerie was saying, at the front end, the 2-year German Bund currently at 2.12, and its bid yields are down 5 basis points at the front end in Germany. And a similar picture in Italy as well, where sovereign debt there at the front end yields down 6 basis points, prices up at 2.57. So money moving into the sovereign debt of Europe, but out when it comes to US Treasuries and UK gilts as well. So a bit of a split picture when it comes to these global bond markets. Coming up, back to the earnings story and the tumult at the heart of Boeing. It's the big day, of course, for the airline maker. The manufacturing giant reports third quarter results today, the aircraft maker, not airline maker. And there's a union vote, of course, on ending the strike action. That story is next. This is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take 2 numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching The Close.
Welcome to Balance of Power.
This is Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Good morning and welcome to The Pulse. I'm Tom McKenzie in London. These are your top stories. Boeing announcing its third quarter earnings. One of your top stories today. Before the US market opens, investors and analysts are looking for the new CEO to lay out his strategy during his debut earnings call. No pressure. Also today, union workers vote on whether to end their strike. Bloomberg's Benny Carmel leads our global aviation coverage and joins us for this essential preview. Benny, it's going to be bad. Just how bad will it be for Boeing?
Well, we already got some of the numbers from Boeing a couple of weeks ago. They announced fairly comprehensive job cuts 2 weeks ago, and as part of that, they threw in some of their earnings as sort of preliminary numbers. So we know it'll be another loss quarter. The sales were not what investors expected, and it'll have a big charge because some of their planes are delayed. They're having issues at defense, the business, and the space business. So the numbers are kind of out there. In some ways, they sort of grasp the nettle. So the focus will be more on the CEO messaging. Kelly Ortberg, the new CEO, he will come with a message to employees and to investors, and it will all sort of be in the tone, you know, how unvarnished might it be? What kind of a vision does he lay out for the future? How deep does he go into the issues facing the company, from the credit rating to the next aircraft? So all of those things is something that people will be poring over. The earnings are out at 7:30 local time. That's 12:30 in London. And then later in the day, as you said, we will get that crucial vote from the workers on the latest accord.
I mean, Benny, you just ticked off a number of challenges that this new CEO faces. So on the messaging question, then, do we have some understanding as to where the priority for Ortberg will be in terms of his communication to his employees, as you say, and to the markets?
So yeah, it's a bit of he needs to get the tone right. I think the employees obviously are, you know, nervous. We had the job cuts, so they will want to hear from him. How do you reshape the relationship between the upstairs and the downstairs of Boeing, between management and the factory work floor? He's already sort of tried to improve that relationship. He's moved to Seattle. He's walking the factory floor. So he's trying to engage with the humble worker, as it were. But he will have to lay out the future of Boeing as it exists. He made some slightly veiled remarks a couple of weeks ago saying, we can't be everything to everyone. We need to think about what we're good at, think about where our focus should be. And that gives a hint that maybe the Boeing that we'll see in a couple of years will be a more streamlined, a smaller or more focused Boeing. So that will be a big focus for workers, but also obviously for investors today.
Okay, and of course, you'll be breaking down those earnings for us, you and the team, and also the decision in terms of the vote when it comes to union workers for Boeing. That's also crucial as well later today. I know you're going to be covering that for us, giving us the context. Bloomberg's Benny Carmel with the expertise, of course, leading our global aviation coverage. Benny, thank you very much indeed. Another exclusive conversation to look forward to here on Bloomberg TV will be with a LinkedIn CEO, Ryan Roslansky. That's at midnight tonight, UK time. Pre-market, let's take a look at McDonald's on the E. coli challenges facing parts of that business stateside. The stock currently down almost 6% pre-market. Starbucks a miss when it comes to the earnings. They've pulled their outlook. That stock also under pressure. Bloomberg's Danny Berger and Manus Cranny join us next. This is Bloomberg.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in our GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning from our global headquarters in New York. I'm Menace Cranny alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set the agenda.
Moynihan's warning, a cautionary note from the Bank of America chief to the Fed.
We got to get back in line. And so they're on that path. They were late to the game. They got to make sure they don't go too hard now. And that's what they are all trying to figure out watching the data.
Consumer woes. Starbucks pulls its guidance for 2025. McDonald's grapples with an E. coli outbreak.
We've taken steps to proactively remove slivered onions, which are used in quarter pounders, from restaurants in select states. We also made the decision to temporarily remove the quarter pounder from restaurants in select states.
And bracing for turbulence, Boeing signals a huge loss to come. Can Kelly Ortberg deliver a reboot? Good morning, Manus.
Good morning, Danny. Well, equities this morning are grappling with this trajectory from the bond market. You don't get a real shakedown in equities. You're a bit lighter this morning. Schwartzman says a recession will be avoided regardless of who is president. As I say, it's the bond market that's traveled higher, and you don't trigger a real buyable dip until we hit 415 on the twos, according to Julian Emmanuel. More from him a little bit later on. Talking about the bond market, there you go. You can see just a tick up by one tick this morning. Again, on the two-year notes, we're up 34 basis points since the Federal Reserve's meeting. And I love the bond market team. They're reflecting on 1995. Treasuries plunged like it's 1995. Let me reflect on 1995. It was the single biggest margin call that I ever had. I hid under a table, and I was like, we'd written puts. We were so bullish on the bond market. We'd written all these puts, and then it didn't go according to plan.
That's fun.
It was massive.
I was 3 years old.
You were 3. I was worried. I was actually worried for my job at that stage.
Very different points in life. Manus, you point out the consumer companies this morning. Yeah. Starbucks also plunging by nearly 6%. We're at such an interesting moment for these companies because you could argue it's idiosyncratic It's a new CEO coming in, but it's not just Starbucks, it's also Nike having the same issues. Aren't we just at a point where consumer companies can't just float along, that they need serious strategy with the end of free money and a consumer that's more picky?
It's the bifurcated consumer. So at the upper end, we know that it's tough times in luxury, but this is the reality of walking in off the street to pick up your Starbucks. Sales down in this country by double digits, down by 10% here, down by 14% in the US. Starbucks on a Saturday morning, I can tell you, it is not a cheap venue to go to. I don't think we can disclose what we buy or how expensive it is.
Are you a Starbucks guy?
I vacillate between Starbucks and Pret a Manger, and Pret a Manger is more expensive than Starbucks.
Okay, we know where you fit on the echelons of the consumer then. Go ahead, Manis.
Well, let's talk about the investors. Okay, you really want to know where we spend our money on a Saturday morning. Investors, they're dialing back their expectations for that rapid reduction in interest rates. The Bank of America's CEO cautioned the Fed against being too hasty when he sat down with Bloomberg yesterday. This is what he had to say.
They were late to the game. They got to make sure they don't go too hard now, and that's what they are all trying to figure out watching the data. But whether it's a terminal rate that's the key, and that we think is around 3%. That's a whole different interest rate environment in the U.S. and other markets than it's been in the last 15 years or so. We haven't come close to that level of front-end rate in a long time, and if that's what is done, that's a better place for the U.S. to be, frankly.
A message from Brian Moynihan there to the Fed. Don't go too hard. Our guest this morning is Alfonso Peccatiello, CEO and founder of Macro Compass. Alfonso, thank you so much for being with us. There's Brian Moynihan saying, look, you were late. Don't go too aggressively. And this chimes for you because you say there's a real risk that the Fed may not just pause in November, but pause in November and December, and it is decidedly a tail risk that's hugely underpriced. But how much of a tail risk is a double pause?
I would say, man, that it's all pending, of course, on U.S. elections. The double pause by the Fed might only happen if Trump secures a red wave or a sweep, because I think at that point, not only the U.S. economy has proven some, resilience in terms of economic data, but also Trump's policies are undoubtedly pushing nominal growth higher, and also the inflationary part as well. So it might be that, like in 1995, as you mentioned that already, the Fed just goes and then takes a little bit of a pause. And the market is adjusting a tiny bit towards that scenario, but not really pricing it in. In bond markets, you can still figure out structures in option markets where you can get paid about 50 to 1, so a 2% implied probability that the Federal Reserve pauses in November and December. I think that's mispriced. If Trump wins the elections and he secures a red wave, would it be the Fed has some thoughts about pausing and watching for his policies before resuming the cutting cycle again? I think so.
Alfonso, is there some degree where higher yields are just about more volatility? JP Morgan points out that volatility is an important driver of term premium, and there's the expected volatility from regardless of who is president and the more spending. Should we not just command higher yields because of that very fact of volatility?
I think you're perfectly right in the sense that when investors decide to take fixed income exposure, they can do it in a couple of ways. They can buy a 30-year bond, or they can just roll over their T-bill holding for the next 30 years. The two things are very different, though, because a 30-year rate implies 30-year duration risk, interest rate volatility you're exposed to, and therefore you're going to be demanding a term premium or a compensation for that volatility. Now, the higher the volatility that you expect in the growth and inflation cycle, the higher your term premium. I think Trump's policies add to the term premium more than Harris's policies. But in general, yes, you're right in the sense that the more fiscal deficits that are pro-cyclical rather than anti-cyclical, permanent fiscal deficits, the more likely it is that term premium should be higher in this cycle.
Well, just speaking about term premium, and Danny and I have looked at this a couple of times, but you would actually say there's not enough term premium out there for the scale of fiscal policy from either side coming through to next year. So how does that reflect in terms of the bond market, the curve shape?
So the term premium is expressed mostly at the long end, man. It's simply because the longer your bonds, the longer your duration, relatively speaking, the more you're exposed to interest rate risk and interest rate volatility, which means you're more exposed to this rapid fluctuation in inflation and growth cycles. So normally speaking, term premium gets reflected at the long end, so that ceteris paribus means long end yields should be higher. Of course, I always invite people to reflect on the fact that long end yields are also a function of demand and supply, and they're also a function of the current economic cycle. But you're perfectly right. term premium should be higher, I think, to reflect the fact that the U.S. is now applying some sort of permanent fiscal deficit policy.
Alfonso, the other asset class you see is mispriced is FX. You write that it seems unprepared for the vicious moves that could come after the election. What sort of vicious moves are you expecting?
Well, I think that the Trump trades, the standard ones, are now pretty crowded. If you look at the skew in bond markets, as we discussed, I mean, people are preparing for a move higher in rates. If you look at banks, they're outperforming as a sector, and Trump's deregulation helps. But in certain currency markets, that's not the case. So, for example, Trump has discussed about reviewing the USMCA deal, which is Mexico and Canada. And so while the Mexican peso has been a bit rocky lately, the Canadian dollar not really. So if you look at option markets, you can get exposure to a downside move in the Canadian dollar, which reflects, again, the renegotiation of Trump's policies, but also the Canadian economy is actually suffering from higher interest rates. Well, those puts or downside expressions on the Canadian dollar are really not expensive. And the other place to look at is Europe, of course, because Trump is also maybe voicing out some ideas of forcing Europe to spend up for defense and reviewing the NATO deal, basically. That is also going to force Europe to spend more, which might be another reason why the euro has a little bit of a downside. In both cases, Canadian dollar and euro, these expressions are not as expensive as a hedge to put up.
Okay, it's going to be an interesting time in less than 2 weeks. Alfonso, thanks for setting it up for us. Alfonso Peccatiello of Macro Compass. Let's get to some other top stories now that are trending on your terminal this morning. Deutsche Bank plans to restart share buybacks. Revenue with investment bank rose, and the lender largely settled the legacy dispute. Bloomberg spoke to the CFO about possible consolidation.
We're always looking at our option set, as any sort of well-managed company should. And domestic consolidation is clearly on the list of things that you would look at as you observe your option set. We've been, I think, pretty consistent in saying the industrial logic for bank mergers makes sense, but that we needed time to be fully ready, and that time hasn't come.
The CDC says a severe E. coli outbreak tied to McDonald's Quarter Pounder has sickened dozens of people and killed one person in the United States. The company said it was taking swift and decisive action to control the outbreak and remove the Quarter Pounder from restaurants in the affected areas.
Boeing is signaling that it will report a huge loss when it announces third-quarter earnings before the bell today. It puts a spotlight on the new CEO, Kelly Ortberg's plan to fix the troubled plane maker. Investors or analysts are looking out for Ortberg to lay out his strategy during his debut earnings call. Coming up, 13 days until the American election. The candidates are blitzing the swing states. We're going to bring you the latest.
And later this on, Gillian Emanuel from Evercore joins us around the desk to discuss his outlook and the risks for election 2024 for markets.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
She worked at McDonald's when she was in college to pay her expenses. She did not pretend to work at McDonald's when it was closed. And she is as prepared as any nominee for president has ever been. That's who Kamala is.
I don't think anyone wants an America where people are worried about retribution of what people will do if you make your opinion known. I think Vice President Harris supports a future for this country where these freedoms and many others will be protected and upheld.
That was rapper Eminem teaming up with former President Barack Obama at a Kamala Harris rally in Detroit, Michigan. Donald Trump called the former president a jerk as he courted voters at a rally in North Carolina. Harris, meanwhile, gave an interview to NBC, skipping the trail for the day. Joining us for the latest on the race is Bloomberg government reporter Courtney Rosen in Washington, D.C. Courtney, if we had been talking last month and we said that Harris wasn't on the trail, instead she was doing a media blitz, people probably wouldn't have believed it. She got a lot of questions about how to distinguish herself from Biden. How is she coming across in her media blitz?
She is appearing on lots of different media with different audiences, talking to journalists like NBC, like you were talking about, and also appearing on podcasts with different audiences. She's appearing pretty consistent throughout them. And it's interesting because we haven't seen her do as much media during her time as vice president. It's really been amped up in the last couple weeks, and it's given journalists and just the public the opportunity to ask questions.
Well, certainly Donald Trump was taking a pop at her yesterday in terms of being in Washington rather than being on the campaign trail. He was reaching out to Latino voters, but at the same time, he's also agreed to go on Joe Rogan's podcast. Joe Rogan didn't want him on his podcast for a couple of years, so this is a meeting of minds. What kind of audience is he going to get out of this podcast? Because it's a significant reach.
Young men, and that's what President Trump and Vice President Harris are trying to target right now, are one of the demographics that they're hoping to turn out. Joe Rogan is widely considered one of the most popular podcasters in the country. His audience is massive, and so when you're trying to court that particular demographic, that's where you go.
Courtney, just again, 13 days away, and everybody says, okay, is there going to be some sort of October surprise? A lot of people on the internet had a frenzy about this New York Times report from John Kelly, Trump's longest-serving chief of staff. Let me just read some of the quotes that John Kelly said. It's a very dangerous thing to have the wrong person elected to high office. He, being Trump, commented more than once, you know, Hitler did some good things too. Obviously shocking statements, but does it cut through the noise at all at this point, so close to the election?
It remains to be seen. John Kelly's comments track with what we've heard from past Trump administration officials, aides that have worked close with the president. It's not unusual to hear these kinds of comments from a former staffer, right? It's something that the Harris campaign has been trying to highlight. Republicans in general that are breaking with the former president and are going to vote for Kamala Harris. One prominent example is Liz Cheney, the former congresswoman from, former congresswoman, good morning, it's early, who is appearing with Vice President Harris on the campaign trail pretty frequently in areas with Republican strongholds, trying to convince voters to what she calls vote your conscience and break with the former president this election.
Okay, well, some pretty strong language in that article in the New York Times. Courtney, thank you very much. Courtney Rosen there.
Thanks for having me.
The trail as we count down to election 2024. Coming up on the show, skipping the lattes, how Starbucks is handling the steepest sales drop in 4 years. Context matters on Bloomberg.
top names in business are on Bloomberg.
The challenge for us now is not very much on the product, it's on the ramp-up of the production system.
We turned the industry down to almost zero during the pandemic. And what we're trying to do now is turn it all the way back on. And that's hard. We lost not only people during the pandemic, we lost a tremendous amount of experience.
A lot of skilled people have left the industry. We have to hire new people. The supply chain has to hire new resources and train the people, educate them.
And because those roles are filled now not by a 58-year-old, but perhaps by a 28-year-old, there's a lot we have to do in terms of not only adding capacity, but capability to meet the ramp that we all are embarked upon.
We have thousands of suppliers, and when you have just a couple of them, few of them that are late on the ramp-up, well, that's slowing down everybody, and that's what we've been facing earlier this year.
Nobody covers business like Bloomberg. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Brief. I'm Manus Granny alongside Danny Berger here in New York. Front pages, this is what we've got. Headlines from around the world. We'll kick off with the Journal. Frontier Airlines exploring a renewed bid for Spirit Airlines. And if the deal comes together, the two carriers, well, it would likely happen as part of Spirit's restructuring its debt and other liabilities in its bankruptcy. Frontier and Spirit have been circling one another, quite literally, on and off merger since 2016. Will it happen?
I don't think planes are supposed to be circling each other. I think that's dangerous.
Yeah. That's what traffic control is for. That's what the producer's for in our ear.
Right. Next up, Bloomberg has this, leading with Starbucks pulling its guidance for 2025 after a sales plunge for a third consecutive quarter. The coffee chain reported a 7% decline in same-store sales. There was weakness evident in the U.S. Companies said basically that this will give the CEO, Brian Niccol, time to figure out a turnaround plan, Manus.
And the New York Times leads with Bill Gates privately saying that he recently donated $50 million to back Vice President Kamala Harris. Now, Gates said in a statement to the Times that this election is different. He made the donation to Future Forward, which is the main outside fundraising group supporting Harris.
Let's talk a little bit about private capital, shall we? Because it has been a difficult market for gathering new money. Even with that, though, EQT, one of the biggest private equity funds in the world, exceeded its target this year and is looking to take away competition. I caught up with the chairman, Connie Janssen, at their Capital Markets Day yesterday.
There is sort of a lot of discussions about we are consolidating certain industries and taking away competition. Typical FTC thing, and they should be looking at it. Of course, they're doing their job, but we should be sensitive. And when we do these kinds of things, we should not sort of misuse the power we have. And you have case after case after case where we have done so, and that's also part of the transformation that we are part of. But we should be a bit more sensitive, I think, to us going too far too fast. Because it will create a negative connotation around this industry, completely unnecessarily, because there is no reason why it should be that way.
I could argue that it's gone pretty far, pretty fast already.
Yeah, and I don't really see any turn in sight. And that's pretty sad.
That is. Shall we talk about something a little bit more, maybe not more joyful? But I do want to ask about this current environment, because again, 30 years you've invested through some different cycles. There's going to be young people coming up in this industry who haven't invested in different cycles. There are people who've never seen high interest rates before, and they've never seen what at least seems to now be a cutting cycle and embarking in a different interest rate. I wonder what you think of the preparedness for this industry as we kind of waffle between expectations of cuts, of easing, of potentially more tightening, of potentially more inflation, just this very volatile macro environment. How prepared is it, and how do you see sort of EQT navigating that macro environment?
I think the macro risks we have been dealing with all the time. But it's always so that when you are in something, what you feel is there now, it's completely new, it's scary, it's risky. But looking back to the 30 years we have been operating, we have been through a lot of different things. We had the pandemic not too many years ago. Everybody thought that the world was supposed to go out of business. We managed that. We're here now. So I think that the cyclicality and the overshooting and the stupid thing with no interest rates and with the correction back to some kind of normal stage, I think those things we can manage. I think the risk that I'm most concerned about are the geopolitical risks right now. Because that's, you can easily paint a very negative geopolitical scenario. And in such a scenario where the whole logic for trade, for international cooperation, if that goes away, goes back to where we came from, those risks, I would say, is more severe and difficult for us to manage than all the other things. I think we can manage all the other things.
My conversation with the EQT chairman, Connie Janssen. Look, it was supposed to be an event where they were really excited about their growth, but it was hard to come away from that conversation and not feel a bit dour. Not only was he talking about geopolitical risk, he really felt it acutely that something more is happening with hot wars popping up throughout the world. And this is what the industry really has to worry about. Who cares about higher for longer rates?
Well, as you and I were just chatting about this, they've weathered 500 basis points of hikes. They've weathered a war in Ukraine, Russia. The question then becomes, where's the next significant hot conflict? And you have this morphine of gray event risk and black swan risk, and the things begin to shift and change, don't they?
Right, and the other thing he also talked about in the kind of beginning of that clip was really critical about the industry just being in asset gathering mode.
Yeah.
And basically when you do that, it leads to more regulation, and they're overlooking that.
But then is the risk that regulators come and stop you from growing, or that they come and actually perhaps break your, look what the regulators are doing with big tech at the moment, and you can certainly say PE and asset gatherers are vast in their size. So the risk is, what, breakup or just stymieing their growth?
Well, I think it could be either, and I think the political environment is such that it doesn't matter who's in the White House. The trajectory is clear for regulators that they're not liking these big businesses, and if you're a Blackstone and you're trying to do everything to everybody, EQT says, watch out, they're coming for you.
They're coming for you. Well, I'll tell you what, it does matter who's in the White House, and especially for the dollar. The muscle exercise that dollar yen is getting. And this just shows you, nobody really knows where we're going to end up. The polls versus the betting markets are very different. Look at dollar yen. This is breaking through the 200-day average, and you got bonds in Japan, Danny, breaking through a 40-year high at 2.53. That's doing nothing to help the yen at the moment.
It wasn't that long ago that everybody was saying, get long the yen, they're going to be hikes in Bank of Japan. King dollar, though, comes to reassert itself. Yen this morning weaker by more than 1%. This is Bloomberg. There is this real momentum from Wall Street.
We are basically deep in the European earnings season. Take a look at how we're faring when it comes to Asian markets.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger alongside Manish Cranny. Let's set your agenda.
Moynihan's warning, a cautionary note from the Bank of America chief to the Fed.
So we got to get back in line. And so they're on that path. They were late to the game. They got to make sure they don't go too hard now. And that's what they are all trying to figure out watching the data.
Consumer woes. Starbucks pulls its guidance for 2025. McDonald's grapples with an E. coli outbreak.
We've taken steps to proactively remove slivered onions, which are used in quarter pounders, from restaurants in select states. We also made the decision to temporarily remove the quarter pounder from restaurants in select states.
And bracing for turbulence, Boeing signals huge losses to come. Can Kelly Ortberg deliver a reboot? Danny, good morning.
It is a busy day for individual companies. You point out there, maybe that's what's dictating the direction of this market. Starbucks, McDonald's, all getting hammered overnight for the reasons that you mentioned. Tesla, Boeing, Coca-Cola, all on deck. S&P 500 futures lower by 1/10. Russell 2000 lead the market lower yet again. Maybe small caps are doing worse because of this. The bond market yields continue to be under pressure. You had the great statistic, Manis. What is it? 34 basis points higher in your two-year yield since the Fed decision. We're up about 2 bips for the 10-year yield, 4.2. We were showing you yen on the bottom of your screen there, declining more than 1% versus the dollar. Manis, it is right now a market that it's difficult to disaggregate. How much of this is about strong data? Is it about the Fed maybe not getting all the cuts they want, and the so-called Trump trade?
Yeah, I think it's a mixing bowl of all of it. If you look at the musculature of the rates market, that is the alpha for the dollar. And that dollar-yen trade, I mean, just 5 weeks ago, everybody was talking about 140, 130, and all the way down. Now it's above 150. How much of that is carry trade? How much of that is dollar? Today, we're going to talk to Julian Emanuel, and I think it's fascinating. He's talking about the trigger point for these equities is 415 on the twos. That's when you get a bit of a shake of the tree, and you get in there and buy.
Well, so many people said the Trump trade, it's going to be great for small caps. Look at what small caps have done over the past couple of days. They are my favorite, and they consistently suffer. Small caps have not done well. Is that a flavor of the Trump trade? I'm interested to ask Julian about that. Stay tuned for that conversation in about 10 minutes' time. In the meantime, Manis, we have some companies to get through. ARM turning on Qualcomm. The UK chip maker gave its longtime partner a 60-day notice of canceling its design license. ARM had sued Qualcomm for breach of contract back in 2022. Joining us now is Bloomberg Intelligence litigation analyst Tamlin Basin. Tamlin, how did we even get here? What's the story behind this?
Right. Well, so the story behind this is we got here because Qualcomm decided to purchase Nuvia back in 2021. Now, after that happened, ARM did terminate its license that it had with Nuvia. And then it later sued Qualcomm, saying even the chips that were designed when Nuvia had that license, you're not allowed to continue building on those. So they filed a suit. That suit is going to trial, it's scheduled for trial in mid-December, incidentally right around when the 60-day deadline is about to expire. That's how we basically got here.
It's interesting. I'm just looking at some of the analyst notes here. JP Morgan say, well, the license cancellation marks an escalation in the disagreement between the firms. An eventual settlement is the most likely outcome. But in terms of negotiating that, what is the impact in the interim period of time? What's the worst kind of scenario, the worst case scenario financially in terms of an impact?
Right. Well, I think the worst case scenario would be if ARM actually was able to terminate this license. This wouldn't be just an impact for Qualcomm. This would roil the entire sort of chip industry. We do think that this is probably more or less a tactic to try to gain leverage and get that new license agreement with Qualcomm that would probably be at a higher rate than what Nuvia was paying ARM. But yeah, this is a much intensification of the ongoing dispute, and it really is kind of a nuclear option for ARM to try to terminate this license.
Okay, they're hitting the nuclear option button. Let's see where it goes to. Tamlin, thank you so much, Tamlin. Bosun, the Basin there of Bloomberg Intelligence. Now, the stock that we're tracking this morning, it is McDonald's. We've been telling you they've a severe E. coli outbreak. It's tied to the restaurant chain's Quarter Pounder. It made dozens of people sick, and it has killed one person in the US. That's according to the CDC. Now, McDonald's has pulled the signature menu from select states.
The decision to do this is not one we take lightly, and it was made in close consultation with the CDC. It's important to note that the majority of states and the majority of menu items are not affected. Other beef products at McDonald's, including the cheeseburger, hamburger, Big Mac, McDouble, and the double cheeseburger, are not impacted.
Eric Vanner is tracking this story for us. Eric, at this stage, it looks like McDonald's response has been swift. It's been aggressive, 49 cases in 10 states. Is it contained? That's, I suppose, the step one question, isn't it?
Yeah, that's right. I mean, it seems like what they're saying at this point is this is something that's limited to one product, slivered onions, they've said, you know, from one supplier that served a couple different distribution centers. It's focused on kind of the Midwest and mountain states in the U.S. So obviously a fairly widespread area, but it doesn't seem at this point like it's spread to other products or other regions, certainly not over here in Europe where we're based. But yeah, something that, you know, has obviously affected a large number of people already.
Eric, it was also a post-tough market session for Starbucks. It pulled its guidance for next year with the new CEO incoming. When Brian Nichols was announced as the new CEO, the stock itself rallied 24%. Is this a moment of pause? What does it tell us about how long Starbucks needs to have this transformation take place?
Yeah, there's probably an element here of, you know, kitchen sinking or clearing the decks, whatever you want to call it. You know, when a new CEO comes in, they want to clear the slate, give them a better base to build on. But it does, you know, it highlights just the fundamental nature of the problems there. A sense that they've lost their focus. They've gone into too many different areas, gotten away from, you know, just being a solid coffee chain, doing all these things for all people. And that, you know, at a certain point, it just has stopped working, right? And so now they have to clear the decks there and get back to basics seems to be the prescription.
Eric, appreciate it. That is Bloomberg's Eric Vanner. All right, we're also watching Boeing this morning. Boeing announces its third quarter earnings before the U.S. market opens. Little change so far pre-market. Investors and analysts are looking for the new CEO to lay out his strategy during his debut earnings call. Also today, union workers will be voting on whether or not to end their strike. Bloomberg's Benny Camel leads our global aviation coverage and joins us now. Benny, let's start with the earnings. What are you going to be focused on?
So the focus really will be on the messaging from the CEO, from Kelly Ortberg. He's been in the job for just a couple of months now, and it's been a really tough job for him. A lot of things to contend with. We know some of the numbers already. They came out with some preliminary data a couple of weeks ago when they announced some job cuts. So we know that sales fell short. We know they're going to have big charges. We know there's going to be another outflow of cash. So that's going to be less of the focus, more sort of in the messaging from Kelly Ortberg, sort of how does he reboot this company? And it needs rebooting on the product side. It needs rebooting on the financial side. It needs rebooting in terms of the relationship between sort of upstairs and downstairs, sort of the management and the factory worker. So all these areas are sort of sticking points for him that he needs to address. He'll come out with a memo to employees and to investors. So that will be very closely poured over. He will also appear on a conference call. So that's really going to be the focus. And then, as you said, later in the day, we will get this crucial vote from workers. And which way it'll go, it's really too early and too difficult to say at this point.
Benny, good morning to you. They've taken remedial action. They've shored up the financial lifeline. The backstop is there to give him the breathing room to really look at how do you restructure Boeing fit for purpose in the future. And part of that is going to be trimming back what Boeing is, and that's about asset sales.
Absolutely, and that's something that he did say a couple of weeks ago, and I imagine that's something he'll be quizzed on today. What will Boeing look like in the next year and beyond, in 5 years. Everyone said Boeing is too big to fail. They're not going to go away. But this is not a company that's too big to fade. This is a company that could sort of fade into the darkness and others take over. So that's something that he will want to prevent. And to do that, he needs to focus on what is this company good at? Where can we put our resources? What is our focus? We can't be everything to everyone, and they need to think about building the next aircraft. People will be looking for any commentary on that. When might that happen? What kind of resources might be allocated to that? So that will really be sort of the crucial part, sort of how do you map out a future for this company that's really been in crisis for the better part of this year.
Benny, part of the crisis, though, had been this criticism that the former CEO and management didn't know what was happening on the floor. It's been a contentious negotiation over these strikes, over pay deals. Where does it leave just the company in itself and the ability to have this morale and understand what day-to-day workers are doing at Boeing?
Yeah, so morale is a big sticking point again for Ortberg, and he's made sort of the right noises since taking over. He's moved his home to Seattle. He's on the factory floor, so they've distributed photos of Kelly Ortberg sort of walking the factory floor, talking to people, touring the sites. So he's made a big point of that, to be close to the action, to listen to workers, and to overcome this divide that long existed between sort of the Boeing senior management that was sort of fixated with the financial returns and the people on the ground building the planes, and one side didn't know what the other was doing, and the demands from the top weren't clearly distributed at the bottom. He wants to get through that, but of course, in order to do that, he needs to get that relationship fixed. And right now, the relationship is broken. The workers are striking. They've turned down 2 agreements already. And if they turn down the third one, it will show just how deep that divide is. But if they can fix it, if they can vote to ratify this accord today, it will go a long way towards healing those relationships. And that really is a crucial stepping stone for him to get the company back on track.
Benny, appreciate it. That is Bloomberg's Benedict Campbell, who leads our global aviation coverage. Those earnings to come before the bell. Coming up, the S&P 500 just broke its longest winning streak since 1955. We're going to dive into the equity market next. Julian Emanuel of Evercore joins us on set here on your Bloomberg Brief.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Why should I want to invest in the pharmaceutical industry? Is it going to continue to grow as it did last year? And what about your own company? Do you think it's going to have good growth prospects over the next couple of years?
I think the reason to invest in the sector is the science. I mean, when you look again, if I go back into the history, for most of the last century, we were only giving people pills and small molecule drugs. Then we discovered that we had this whole world of biologics, and we could treat diseases with biologicals. More recently, we've discovered that we can reprogram your cells, we can edit the genome, we can use these RNA therapeutics to completely transform areas of medicine. Those technology areas are at their very nascent stage, and what we're going to find is they're going to open up whole new areas of growth from our business standpoint and a human health impact standpoint. We hope that as we work in our areas like cell therapy and RNA therapeutics, we will also be able to climb to a whole other level of market cap over time.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
You're watching Bloomberg Brief. Danny Berger and Manus Cranny in New York. The S&P 500 after yesterday just saw back-to-back down days. It hadn't done that, though, in 31 days. That is the longest streak for this equity market since 1955. Joining us now is a man who has a 6,000 price target on the S&P 500. It is Julian Emanuel, Chief Equity and Quantitative Strategist at Evercore ISI. Julian, great to see you. Thanks for coming in so early this morning.
Great to be here.
So you put out a great note just moments ago this morning. I actually don't know how you did that because you're standing in front of us right now.
Magic.
Technology.
Technology.
You point out that the bond market volatility has really injected something into this equity market, and perhaps is the reason we've seen those 2 days of back-to-back declines. Just how sensitive are we right now to the bond market and a lot of event risk coming up in the next few weeks?
So it's really about the element of surprise. Okay, we know there's an event on November the 5th that by all rights is going to deliver surprise one way or the other, contested, uncontested, divided or unified. But the real surprise is that if you go back to September 18th, when the Fed cut 50 basis points, 10-year yields are up 60 basis points, and 2-year yields are up 40 basis points. And the fact is that what really has happened is that was a ratification of the soft landing. You've also, at the confluence of the fact that both candidates' policies are likely going to increase the budget deficit and perhaps cause inflation to continue declining at a slower rate or even stabilize. And so putting all that together, it's no surprise that we're experiencing a little bit of volatility, particularly since stocks are trading at 24 times earnings.
I mean, you warn about, there's a lovely line in this from James Carville, who of course masterminded a lot of the election triumphs, and you talk about the bond market, you can intimidate everybody. But for you, 2-year notes have got to get to around 415 before it really begins to show some flex in really intimidating this market, this equity market.
Yeah, and because of the sort of, I wouldn't call it binary, but the multivariate nature of what could happen after the election, it is certainly possible that the markets decide to ignore the fact that rates have continued to rise, and you get into sort of a melt-up scenario, and we suggest that if, in fact, the election is, quote, unquote, clean and uncontested, whoever wins, that's sort of how you get into the melt-up scenario. But the sort of countervail to that is if it's a messy period, sort of how the election came out in 2000 with the sort of hanging chads, that's where the focus on the fact that interest rates have risen as they have could put pressure on the market.
But would a clean outcome with a red sweep not do something similar, just in the idea that the deficit's going to swell a lot more than it would under a divided Congress or a blue sweep, and higher yields then pressure equities? You think even in that scenario, equities can do okay?
Well, longer term, that's certainly a possibility. But when you think about the dynamics of 2024 in particular, it's been a very good year for stocks, as we all know. And the work that we put out around Labor Day showed that actually in presidential election years where the markets were up double digits on Labor Day, you finished higher on December 31st, 6 times out of 6. So I would suggest that if, in fact, you got the red sweep, there'd probably be just a relief that there was a known and decisive outcome, and that would, in all likelihood, trigger sort of a performance chase that we sometimes see from hedge funds coming into year-end, which is positive seasonally 8.5 to 9 times out of 10 anyway.
Look, the betting markets are saying one thing, and we know that there's a skew in the betting markets, but the polls are not showing a real probability of a red sweep at the moment, which then takes us back to the sort of chaos theory that you put forward. And you look back at Al Gore in 2000, you talk about these hanging chads. The market dropped by 12%, then bond yields spiked by 100 basis points. Should we have a base case of contest and quasi-chaos after this election? Because the litigation's already started.
I don't think it's a base case by any means. It is certainly, a reasonable probability in the, really plethora of scenarios. Okay. And it's part of, so what we've done, we have that 6,000 price target, but what we actually did was rejigger it based on the probabilities we assigned: red sweep, blue sweep, divided, contested, uncontested. And actually what we found was the sum of those probabilities get us to 60-70. Only what's happened is because the market's advanced so much over the last several weeks, you've created a greater degree of risk for either those tail outcomes, gotcha, a decisive result, or the downside of a contested result.
We've basically spent 5 minutes without even talking about earnings so far here in the start of earnings season. Shall we get into it? I want to talk about the consumer companies specifically because they have these idiosyncratic problems. McDonald's certainly idiosyncratic, Starbucks, but it's the same story at Nike, a new CEO. How much do you look at these things and say these are one-off, or this is a wider problem with consumer companies that are sensitive, that are struggling, and the sector as a whole is challenged? Well,
there is an element of one-off, but the backdrop to a lot of this has been what has been the prolonged weakness in China, and that's filtering to a lot of these multinational companies. And that is something that, I think is part of what the policy response has been in China in recent weeks, and which is why we're actually optimistic looking to 2025, not only on China equities, but the companies selling into China. And so, again, the backdrop is the labor market is good, the consumer is still good. The holiday selling season looks, by all rights, particularly if you think about it from a stock market barometer, is going to be good as well. It's not gangbusters, but it's solid, which is what we need at this point in the cycle.
I like how you described financials last week. They were triumphant. We get ready for Mag 7. Part of the narrative, NVIDIA made another record high just the other day. So there's a lack of jangling of nerves around NVIDIA. As you prepare for Mag 7, what is it that you expect? We still expect high double-digit growth, but that's a taming of the earnings outlook. How prepared are you for Mag 7?
Well, and we're going to find out, when we hear from one of those companies later this afternoon, but next week is clearly the critical week. The issue here is we know the earnings are going to be good. Yeah. These companies tend not to disappoint. But has the interest rate market moved far enough such that high multiple, long duration stocks like these companies, where the earnings reaction will be muted or even perverse given what we've seen in interest rates? We don't think we're quite there yet, so we do think the focus will be on what the actual results are. But again, at this time of year, and we made it through those first 5 minutes without talking about earnings, it just shows there's a lot of noise in the markets.
Yeah. What's your trigger point? When does it disrupt? When do rates disrupt the market?
So we're looking at the 2-year yield moving above 415 as the point where I think people will start to get uncomfortable.
Grant, well, let's count down to Tesla. I'm still faithful to all the coffee shops all around New York. Julian, thank you very much.
Thank you.
Julian Emanuel of Evercore, our guest this morning. Coming up in the show with Danny and myself, we'll set you up for the trading day, the beige book. I know they get excited about that on surveillance because context matters every day.
countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
As we spend some time here on the broader presidential race,
let's focus in on European politics.
Makes you wonder how politics might play out.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
It's Bloomberg Brief. Danny Berger and Manus Cranny in New York. Let's set you up for your trading day ahead. We're going to get a lot of earnings. Boeing, Coca-Cola, Hilton, they come before the bell. And then we're going to get one of the Mag 7, Tesla, that after the market close. We also hear again from ECB President Christine Lagarde and BOE Governor Andrew Bailey, plus the BOJ Governor Ueda. That all happens throughout the day. Plus, the Fed will be releasing its beige book at 2 p.m. Eastern. The Fed perhaps more carefully looking at anecdotal evidence this time around, Manus.
Danny, we've got some micro movers to keep an eye on. This is what we've got for you. At McDonald's, we've been tracking this story through the morning. This is the quarter pounders been taken off the market. It's linked to E. coli, so it's been taken off the market in certain districts. Dozens of people have become ill in Colorado and Nebraska, and one person has died. Starbucks down 5.4%. They're suspending their 2025 guidance. Another sales slump here in the United States of America and in China. And Texas Instruments bid up by nearly 4%, extending the post-earnings gains. Nice beat on the results, overshadowed by a disappointing outlook. So that's the state of play on those. Danny?
Yep, certainly earnings in focus. Julian Emanuel says that the consumer companies can come back with China's stimulus. Let's just take you out on a look at currencies this morning. Yen weaker by about 1% versus the dollar. Surveillance will take it from here.
What would you say somebody young who's watching this should do if he or she aspires to be like you?
There's one component of our industry that people need to focus on, and it's not technical, and that's communication skills. Focus on being a phenomenal communicator, invest in that. Think about it, we have to convince a company to sell to us. You just don't walk in and buy the stock or tell them, yeah, you're for sale, I'll pay you this price. That takes years of relationship and effort. Why would somebody sell you that billion-dollar software company growing at 20%? Just because? No way. People hang on to these great assets. And then how do you get on the same page with the executive team of that company, even if they're existing or new. It requires just amazing communication.
If you go to a cocktail party and somebody comes up to you and says, I have $100,000 I'd like to invest, what do you would recommend that person do with $100,000? What do you think is a good idea to do with $100,000 today?
Sometimes they do, and I give them the most boring answer ever, S&P 500.
Just buy an index.
Buy the index. You don't have to worry about the quarterly earnings of a company. Did something change? Did somebody change management? You don't have to make this your full-time job. Just buy the index and you're going to be okay.
DOJ or other authorities.
Could face bigger challenges.
It was going to keep rain World Cup.
This is a three as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
The US equity market has done so incredibly well. It's been an incredibly strong performing market.
I do still think that corporate earnings are actually still doing quite well.
At the end of the day, valuation does tend to matter. I don't think valuation is dead.
We think that valuation discipline probably is the most important thing to have at this time.
Focus is so much on the Mega 7 and following the trend there that a lot of these different pockets of the markets are beginning to see some fundamental momentum.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday on a two-day losing streak on the S&P 500 for the first time since early September. Equity futures this morning, negative by 0.2% on the S&P. On the Nasdaq 100, we're down almost a third. On the earnings calendar today, AT&T, IBM, Boeing, Coca-Cola, and Tesla in focus this morning. Big disappointment over at Starbucks. Suspending 2025 guidance, numbers down 10% in the US, down 14% in China. That stock is lower, Lisa, by 5%.
And this is basically coming after a slew of bad news for Starbucks, new leadership, and a question here as they strip out and say they are going to suspend any guidance for the full year. Is this just cleaning the slate, or does this indicate something more material at a time where they basically say they need to fundamentally change the business model, with baristas complaining about not necessarily having enough staff, with too many products, and really a question about some of the boycotts and other issues globally?
When you look at the research, it looks like potentially there's going to be more tough quarters ahead for Starbucks, Edward Jones. There's going to be some tough quarters moving forward at Jefferies. Tough road ahead and re-accelerating what's going on with the traffic worldwide. Morgan Stanley, remarkably poor. What was so interesting, I found, is that transactions in the United States down 10%. That is the steepest from the depths of the COVID-19 pandemic, when no one was out and about getting Starbucks coffees. They were home, isolating.
If you've got a foot in the US and a foot in China right now, you need that foot in the US to perform. And that's not happening. In China, the numbers were dreadful. This is what L'Oreal had to say on China, because it's not just Starbucks. In mainland China, the beauty market, already negative in the second quarter, continued to deteriorate. LVMH, just last week, you will remember this line. Consumer confidence in mainland China today is back in line with the all-time low reached during the pandemic, COVID. As you say, things are not great over in China.
Carrying reports after the bell today, a real question here about how much you see that continuation in luxury goods, which is the reason why it's so interesting that Apple was sort of a distinction. We talked about that earlier this week. Tim Cook over in China for the second time this year, talking about its commitment to the area. How much do executives basically have to go kiss the ring in order to get some sort of money into their coffers? Or is this an issue of just the product mix and where consumers in China are buying or not?
We've got to talk about McDonald's as well. In the pre-market, negative by more than 7%. News late yesterday afternoon, an E. coli outbreak linked to Quarter Pounders over at McDonald's.
And this is particularly in a number of regions that are in the center of the nation as well as out west, and a question of whether it's linked to the onions with one supplier. I know this is really ridiculously specific, but that's the level of specificity. It's just an unfortunate blow for a company at a time when ultimately there are some real questions on a consumer level, how much appetite people have, how price sensitive people are, how much of a liability is it to have to take your Quarter Pounders off and start worrying about onions.
It's not good at all, let's put it that way. We're down about 7% in the pre-market. More on that story a little bit later on this morning. More broadly, equity futures near session lows. We're down
0.25% on the S&P 500. In the bond market, the grind higher continues. Bramo, yields up 2 basis points, 422.
And these are the highest levels that we're seeing on 10-year yields going back to July 25th. I have to wonder how much we're seeing the sort of derotation in equities. We were talking about the rotation into cyclicals, into small caps, and that all came with this beautiful decline in yields. And everyone was saying disinflation's amazing, the Fed's going to cut rates, inflation's going to come down. That's been challenged. And how much is that challenging the entire narrative of a market with yields that are now at the highest levels in more than 2 months, at the same time that you're seeing a sort of rotation back into the big stocks? And that's sort of one of the questions. Is that sort of a blip or the new trend?
So we've had a big debate around the table about whether this is the economic data or whether it's the politics. And we noted yesterday that the move was global. We saw this play out in Europe, in Australia, not just the United States. There's a bit of divergence emerging this morning between Germany and Europe. At the front end of the curve, on a German curve, the 2 years down 7 basis points this morning. Now, I know it's only one day, but when it comes to the election and the policies that we could see from a Trump presidency, wouldn't you assume that would lead to a disinflationary shock in Europe and lead to lower interest rates, and the prospect of leading to higher interest rates, or maybe at this level in the US, an inflationary shock, and we'd see further divergence? It's one day, but it's something I think we've all got to keep on our radar.
Especially because we talk about China, where are they going to sell their products into Europe? It just raises this question, though. We've been exploring this, and I was thinking about this overnight. How much can you see a divergence between the US and European bond markets, even if they do get disinflation, even if they have deflation, even if the ECB is cutting rates? How much is the global bond market linked? Because otherwise, why do you explain yields going higher in certain regions when the economic data is stronger in the US, not Europe, when the inflation data is stickier in the US, not Europe? So these are some of the questions you have to wonder about the connections, interconnectivity of the bond market globally.
The 2-year in America up a single basis point, just north of 4%. Coming up this hour, we'll catch up with Ben Gutterich of Invesco, seeing a positive mix for equities. We'll speak to Seth Goldstein of Morningstar ahead of earnings from Tesla, and Jordan Rochester of Mizuho on the so-called easiest job in Washington. We begin this hour with stocks on a 2-day losing streak for the first time since early September, as elevated bond yields and the prospect of a slower pace of Fed rate cuts continues to weigh on sentiment. Ben Gutterich of Invesco remaining bullish on equities, writing, "We're seeing resilient growth, moderating inflation, and more accommodative monetary policy. Despite challenges, this is generally a supportive mix for equities." Ben joins us now. Ben, let's talk about one of those challenges, the election. How do you expect us to trade over the next few weeks into that one?
Well, look, I mean, there are multiple outcomes, both of different colour and different mix, and one would expect the market to can so easily have a tantrum to one outcome, could so easily fly on another. But we would say over the fullness of time, markets tend to sort of fade extreme reactions. I would say such is the dynamism of the US economy and quality of management and innovation within businesses, that despite hedge funds, whacking on and taking off trades, from one day to the next in and around the event, stock markets can get through this in a positive, would get through this in a positive fashion.
Ben, how much of a constraint is the bond market right now, with 10s back up to 422 and a 2-year with a 4 handle?
It's not a constraint just yet. I think whilst the Fed and the market still believes we're in a cutting cycle, and that growth can remain resilient to that, alongside that, then markets can continue to perform. I think quite as expected. Markets will sort of check themselves and showcase volatility as the pace of cuts slows, and there are some question marks about whether hikes come back to the table, but the trend remains a disinflationary one, and therefore supports a cutting cycle, and therefore I think markets can deal with yields at this level.
Let's define markets, Ben, when we talk about markets being able to deal with rates where they are, even as they climb a bit. And I say this because we have seen a challenge to the rotation trade. We've seen a challenge to this idea that small caps and the rest of the 493 in the S&P can perform and outperform. We've seen a challenge to that as yields go higher. Do you think that sticks?
Yeah, I mean, it looks to us as though there isn't sort of an imminent catalyst for a yield reversion. Of course, growth looks better, so a reappraisal of of how dovish the Federal Reserve might be. Certainly a focus on supply of bonds, given the sort of political agenda really of both parties, and better growth. So, you know, it does look as though yields will be are well supported at this level. That supports, we would say, you know, higher quality. The funding challenges that higher yields bring suggest that higher quality businesses might continue to sort of shine in this environment. But I think ultimately we return to a disinflation narrative, and that the sort of softer landing, resilient growth becomes the focus once again. So in time, I think there is a sort of a catch-up trade from the sort of small mid-caps, but perhaps that's not the immediate position to take today, given there is some nervousness about this sort of higher yield environment.
Ben, we're talking about the higher yield environment in the U.S., but as John was mentioning, it's global. And we've seen yields really tick up around the world, even when the data might not be as obviously supportive as in the U.S. How much is the U.S. setting the tone and the rest of the world gets subjected to it, and that's it?
Well, I mean, I think that is the case. I mean, I'm sure it's not quite such a surprise for everyone that is the case. I mean, it's interesting at this moment, I think, as you sort of said, is that Europe's going through quite an appreciable sort of growth wobble at the moment. Certainly some, you know, the manufacturing weakness weighing heavy on the European economy, and yet bond yields moving higher, sort of dragged higher by what's happening in the US. But, you know, such is the dominance of the US economy, and such support, avoidance of recession in the US offers the global economy that is sort of dominating at the margin on bond yields. But for sure, the growth challenges look a little more precarious in Europe, and therefore the opportunity for duration, for buying bonds, and the opportunity in yields looks a little bit more apparent at this moment in Europe.
One place in Europe, though, you do like is the United Kingdom. Why do you view that as a hedge?
Well, I don't know if you've heard the argument before, but valuation looks interesting. You tend to get a bit of eye rolling at that because it's been sort of trotted out, I don't know, for the last 15 years or something. But valuations certainly look interesting relative to some global comparators. Certainly dividends are always interesting. But I think relative to some very downbeat expectations, growth could impress. But look, the hedge reflects, you know, sort of commodity-rich components of the UK market, and thinking about a geopolitical hedge in amongst the valuation hedge makes it a reasonable portfolio complement to a more substantial position in US equities that we harbour.
Hey Ben, it's good to hear from you. Ben Gunrich there of Invesco on the latest. I wasn't rolling my eyes. I remember when I first moved here, and it was a guest. And I think they said this on air. They said to me that Europe was good for vacations and not for investing. And I was personally offended. Then after about a year, I realized that they were probably right. That Europe was only good for vacations and not investing based on the returns we've seen in America compared to Europe over the last decade.
I mean, even last night, when you looked at all the earnings that were coming out from the European region, in the U.S., beat. Things are looking okay. Even those that disappoint, we're able to raise prices. It's going to be fine. In Europe, some big questions. I don't know about China, whether the consumer were uncertain, and stocks going to the tanker. So this is sort of this highlighting the differential between the two regions.
You tell me which sector is going to perform, and I'll tell you which index will do well. 1% of the FTSE is tech. 1%. It's like nothing.
Okay, there is an argument, and this is actually the bull case in the UK. You're welcome. I think that there is this argument that there is the old industry, the dinosaurs, the clunkers, and the whole idea— Jurassic Park, right? That's your comment. And I just wonder how much you start to see this revival in the idea of the industrialization, the reindustrialization of the world. And if that's the case, then maybe there can be some real outperformance.
That's Ben's argument. We'll see if he's right. Equity futures right now on the S&P 500 down about 0.2%, with an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Shares of McDonald's down 7% in the pre-market trade. The CDC said that a severe E. coli outbreak linked to McDonald's Quarter Pounders has killed one person and sickened dozens. Most of the cases are in Colorado and Nebraska. McDonald's has identified onions as being the likely source of the outbreak and removed the Quarter Pounder from its restaurants. Starbucks also down decisively 5% in the pre-market trade. The coffee chain reported its steepest quarterly sales drop in 4 years. It pulled its guidance for 2025. Starbucks said withdrawing guidance for the current fiscal year will give the new CEO, Brian Niccol, an opportunity to solidify a turnaround plan. The LA Lakers made basketball history last night when LeBron James and his son Bronny became the first father-son duo to play in the NBA together. The 39-year-old superstar and his 20-year-old son played for almost 2.5 minutes together late in the first half of Bronny's NBA debut. The elder James finished the night with 16 points while his son was held scoreless, recording 1 rebound. The Lakers beat the Minnesota Timberwolves 110-103 to tip off their season. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the program, Jamie Dimon's next move.
A lot of things we've done which I think are bad, whether you're Democrat or Republican, or you support, it's often done in the name of good, have hurt the lower 20%. I reserve the right to do whatever I want. Okay, I'm a citizen, I can vote, I can say what I want.
The latest reporting on that, up next from New York. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
Two days of losses could become 3 on the S&P. Futures negative by 0.2%. Bond yields just a little bit higher, up a single basis point. The 10-year, 421.97. Under surveillance this morning, Jamie Dimon's next move.
A lot of things we've done which I think are bad, whether you're Democrat or Republican, or you support, it's often done in the name of good, have hurt the lower 20%. I think we have to be very clear-headed about how we can accomplish what we want to accomplish to lift up all of America. I reserve the right to do whatever I want. Okay, I'm a citizen, I can vote, I can say what I want, and stuff like that. I've never been in the practice of endorsing candidates, and so, but I'm thinking through what I want to say or do or something like that.
So here's the latest. Jamie Dimon reportedly telling associates he supports Vice President Kamala Harris, but fearful of blowback, he's holding back from saying it publicly. The New York Times writing, Mr. Dimon has made clear that he supports Vice President Kamala Harris and would consider a role, perhaps Treasury Secretary, in her administration. Joining us now is Bloomberg's Katie Lyons. Katie, that's New York Times reporting. What is reporting elsewhere telling us about this move?
Well, there's been a little bit of pushback from Forbes, John, that is reporting that Jamie Dimon is not considering being part of either a Kamala Harris or Trump administration, whichever one we end up with. So pushing back a bit on that suggestion in the New York Times that he would be open to serving as Kamala Harris's Treasury Secretary. All that said, when we look at the Times reporting, it is noteworthy that Jamie Dimon is a registered Democrat. And again, the Times is saying he's just not being vocal and public about his support for Harris over fear of retaliation. And that was what was really dominating conversation conversation around this here in Washington was that was the premise on which Jamie Dimon is choosing to keep silent here, over concern about potential retaliation, not just against him, but the public company that he leads and potentially shareholders by extension, as Donald Trump has not necessarily made secret his feelings about retribution. Now, we were just hearing there the Jamie Dimon interview that Lisa conducted earlier this month, in which he talked about not just his withholding at this point of an endorsement, which he is still mulling over and again has not made publicly, but also some of the ideas of what he would like to see out of a future administration, including potentially represented on the cabinet someone from the private sector, or perhaps even someone from the opposing party of whoever the president is. And on that note, we have seen Kamala Harris kind of supportive of that idea. She has said on multiple occasions she would appoint a Republican to her cabinet, and certainly she has been campaigning with a number of Republicans in these last few weeks here of the race as she tries to court those voters. So it's possible that Jamie Dimon likes what he sees on that front. But again, this is not a public endorsement that he is making.
Kayleigh, individuals I spoke to said the Harris campaign does not forget the comments he made about former President Donald Trump in Davos. But just taking that aside, could you see any Wall Street CEO being the Treasury Secretary under a Democratic administration?
I mean, it's certainly possible, Anne-Marie, though it's hard to identify if it's not Jamie Dimon who that person would be, and especially considering there are other candidates in the running. There's been a lot of conversations I've had recently about Wally Adeyemo, obviously currently Deputy Secretary, someone who is very young but potentially could be elevated to the role of Treasury Secretary, and a number of others who would be considered here. When you're considering the Democratic Party as a whole and the kind of pushback that might come from the left, from people who are more skeptical of Wall Street, some of the very constituents that Harris would need, the coalition she would need to elect her president, there certainly could be some blowback there. But I think a lot of people would tell you when we're considering cabinet conversations with less than 2 weeks to go until Election Day, that's not where the primary focus is at this time, is they're just trying to turn people out at this point.
And of course, also trying to make sure they still get the fundraising. That game is still entirely in play. And that brings us to this next story coming out of the New York Times as well, saying that after decades of sitting on the sidelines of politics, Bill Gates, one of the richest people in the world, has said privately as well that he recently donated about $50 million to a nonprofit organization that is supporting the VP Harris. How significant is this, given the individual Bill Gates has notably been very quiet for decades on his political standings?
Yeah, and this was supposed to be quiet too, Anne-Marie. The donation he made, according to the Times reporting, was to the nonprofit arm of Future Forward, which is one of the main outside groups supporting Harris. That is a dark money organization that does not have to disclose its donors. So this was not necessarily supposed to come to light. And Bill Gates, in a statement to the Times, didn't confirm this donation or outright endorse Harris, just saying that he views this election as, quote, different, with unprecedented significance for Americans and the most vulnerable people around the world. So obviously, this is a sizable donation, and it is worth pointing out we are seeing some of the richest people in the world having an outsized role in the money race in this campaign, including on the other side, where Elon Musk has donated $75 million to America PAC, an organization that is supporting Trump, and is now giving out $1 million to a registered voter through a sweepstakes if they support a petition to support the right to free speech and to bear arms. So money certainly is still playing a role at this stage in the game. Where it goes, though, is really what is starting to shift. It's not just about paying for advertisements right now, but it is about actually being able to invest in the ground game and people to go knocking on doors. Donald Trump has largely been outsourcing his ground game, not necessarily the case with Kamala Harris, that has raised more than $1 billion since she launched her candidacy this summer. They have 2,500 staff across 350 offices throughout the country, going out, knocking on doors, doing that ground game, trying to turn people out to vote. And in a race with margins this tight, the ability to contribute money in that way toward the turnout game is what ultimately could make the difference.
Kayleigh, forgive me, I do kind of want to focus on policy, and I want to link these two stories together. We talk about how we don't know who the cabinet is going to be if Kamala Harris were to win. We have some sense of Donald Trump's, because there are a number of people that we've talked about who are potentially being considered as Treasury Secretary. We've talked about some of the transition committee led by Howard Lutnick. Do we have a sense of who the characters could be who might be Kamala Harris's right-hand people?
Well, there are people that are close to her. In many ways, there may be similar faces to what we've seen in this Biden administration that she, of course, has been a key part of over the course of the last 3.5 years. I mentioned Wally Adeyemo. There are others who have been in the mix as well, including Lael Brainerd, who, of course, is currently at the National Economic Council. And there's some question as to how much continuity there would be with the well-known in Washington to this administration moving forward into a potential Kamala Harris administration, as she has tried to articulate, especially in recent interviews, the idea that her presidency would not be a continuation of Joe Biden's, although she hasn't necessarily clearly defined how those differences would really manifest themselves, just that she would have new ideas, and potentially that would mean new faces as well. But we really haven't seen it come into focus to the same extent we have seen on the part of Donald Trump. Many of the surrogates that are out there for him, people who ran against him even in the primary cycle, have been very vocal in their support of him, making the rounds, doing the circuit, if you will, including people who could potentially be Treasury Secretary. You mentioned Howard Lutnick, but of course there's also Scott Bessent to consider here, as well as many other names, including members of the Senate, like Senator Bill Hagerty of Tennessee, who I've heard for both Treasury and state. There's just more people who have already, or who are still potentially serving roles in government on the Trump side, compared to Kamala Harris, who is leaning heavily on people who've already exited their government roles, like, say, former President Barack Obama, who has been on the campaign trail for her in recent days, will be joining her, as well as his wife, Michelle Obama, in the days ahead as they hit more swing states.
Kayleigh, got to squeeze one more in. The big one, Joe Rogan. Is that official now?
According to Politico, that podcast recording is happening on Friday, John. Donald Trump had said he would be sitting down with Joe Rogan, so that is our understanding, is that that interview will happen on Friday. Both of these candidates really hitting the podcast circuit here in the final weeks of the race.
That's a big one, the biggest one.
Yeah.
Kayleigh, down in Washington, D.C. Kayleigh, appreciate it. Thank you. Kayleigh Lyons there. You can catch up with Kayleigh, of course, on weekdays at 12 and 5 p.m. Eastern on Balance of Power. That's the one the Trump campaign has wanted for quite a while.
Yes, and also there is some beef between Joe Rogan and the former president. Potentially it's been squashed now because Joe Rogan came out and was very supportive of RFK Jr. That's going to be very interesting. This is Trump, though, just shoring up his base. It's basically like Kamala Harris going on Call Her Daddy. The more interesting interview will be if Kamala Harris decides to sit down with Joe Rogan.
We'll see if he makes the offer at the start of that conversation a little bit later this week. Up next on the program, Tesla results are just around the corner. We'll speak to Seth Goldstein of Morningstar in just a moment. From New York City, with equity futures on the S&P 500 just a little bit softer, we're down by 0.2%, and bond yields just a little bit higher, up a single basis point on a 10-year 4.22. From New York, this is Bloomberg.
the Vivian Tom clientele.
Yeah, power women, like the dragon women. They're lawyers, they're CEOs, they're all important decision makers, women in the world.
Why do you position your products for this group of women?
When I started, designing, I always want to do something that just empower women.
When you take a look at your store, there is something for everyone. Take a look at the T-shirt, for example.
My customer growing, like 30 years already, so they become more powerful. I also want to grow my Gen Z audience too, They are like in the 20s, so it's a more affordable price for them. And then, my powerful woman's daughter wearing their mom's dresses, and they feel that the power, the energy. So now they come back to the store and they buy more.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
The stock market rally stalling to start the week, down a little bit on Monday, same again on Tuesday this morning, negative by 0.2% on the S&P. The first back-to-back losses on the benchmark in America since early September. It's been a while. On the Nasdaq, softer this morning, but on the Nasdaq 100, 5 days of gains. So tech is holding up in the face of higher yields. So let's talk about higher bond yields. Once again this morning, making a bit of a move in a bond market on a 10-year, up a single basis point, 421.77. On twos, Lisa, up 1 to 4.04%.
You put these ideas together, you've seen a real outperformance from big tech, you've seen an underperformance from everything else, in particular from the Russell 2000. You have to wonder, the more that yields climb, the more that some of these more yield-sensitive areas start to retrace some of the gains. You have to wonder also how far it can go. Is this a bet on higher inflation? Is this just a hedge against the election at a time where implied volatility in bonds is the highest so far this year?
Bring up the charts and look at where the 10-year was on September 18th. We've talked about this a few times through the week. September 18th, the Fed reduces interest rates by 50 basis points. The 10-year's adjusted higher by 50 basis points since then. Check out the FX market. Dollar yen, the low of the year on dollar yen, 140. 2 days before the Federal Reserve cut interest rates by 50 basis points. And here we are at 152.63 and up another 1%. Remember the call for a weaker dollar? The Japanese yen was going to make a comeback. Here we are, back at the 150s.
This came after Japanese policymakers came out with proclamations. Maybe they don't need to hike rates so quickly. You had some data that actually disappointed, gave them some leeway. And then now there's sort of this question, will they, won't they? Bond yields. Did you see that 40 yield? Year yield over in Japan, the highest level going back to 2008. Just a real question mark about how much they've really tamed or not some of the losses that they previously had.
And some real divergence elsewhere as well. If you just look at euro dollar this morning, the euro with a 107 handle, 107.81. We're down 0.2%. We've talked a lot about the growth differentials. Rate differentials kicking in as well this morning. The German 2-year down by 7 basis points, just north of 2%, at the same time that the US 2-year is up a single basis point. So that spread gets a bit wider.
I just wonder how much we can widen out, right? I mean, this is really one of the key questions at a time where traditionally the bond market has been global. Unless you get a real change in the dynamic of the fixed income, of the FX transmission mechanism, you have to wonder whether basically U.S. yields are going to rise because there's strength and European yields won't go down as much as they otherwise should to stimulate that economy because it is a global bond market. It's sort of the issue that they've got to deal with.
That's the cross-asset picture this morning. Plenty of single names as well to talk about. Under surveillance this morning, Starbucks delivering disappointing earnings, pulling guidance for 2025 after sales plunged for a third consecutive quarter. The coffee chain reporting a 7% decline in same-store sales, with weakness especially evident in both the United States and in China. Lisa, Starbucks down almost 5%.
Yeah, 10% declines in the U.S., something like 16% over in China at the same time that they're dealing with a real existential question. What is their business model? How many baristas are they going to have in each store? What's the product mix like? Can they continue charging $7 for a pumpkin spice latte? I mean, these are some of the key questions as they try to figure out what's the price point. I know that parents might be trying to restrain their children from deploying overly aggressive cash hauls over at Starbucks, but, you know, a real question for the new CEO.
And overly aggressive caffeine for those children, not just the cash haul and getting that caffeine.
Don't even.
But the interesting point here, and Jonathan, you brought this up earlier, is they're being hit on both sides. If you cannot make up the growth in China, which is down 14% according to the latest earnings report, then you need to be growing. You need to have that traffic continuing in the United States. And what hit me is this is the worst quarter going back to the depths of the pandemic. So that seems like, is this the bottom for Starbucks, or potentially is there more room to fall for them when it comes to that traffic?
The new CEO has got a massive job in front of them. Their stock is down by more than 4%. Elsewhere, Texas Instruments saying the timing is right for a recovery in orders following 8 straight quarters of revenue declines, adding that 3 of its main markets have begun to rebound, but its biggest sales sources, industrial and automotive chips, are still suffering from excess inventory. So off the back of that guidance, the stock climbs by 3.5%. But I want to go back to something that Lisa pointed out in the last few weeks on this program. The difference between supplying the AI story and supplying everything else. AI is fine. Everything else, not great at all.
But this doesn't really make sense after a while, because you have to imagine for AI to continue being its sort of behemoth self, it has to trickle over into autos. It has to trickle over into the industrial sector. There has to be an application aspect of it that goes beyond cloud. And that's sort of the gap that needs to get bridged that we're not seeing just yet.
What I found interesting is on the conference call, management is saying that the strength actually came from the Chinese electrical vehicle market. Why? China keeps producing them. They keep producing them with subsidies and dumping on other markets. But weakness in the auto sector outside of China is where it is very weak. So they're still able to sell into China, and China's doing well in that EV market, but everywhere else, it's going downhill.
One more name for you, getting tons of attention over the last 12 hours or so, McDonald's. Quarter pounders linked to a severe E. coli outbreak. That stock is down by more than 7%. Dozens of people in the US falling ill, mostly in Colorado and Nebraska, and one person dying. The company's saying slivered onions with a likely culprit, and it's removing the hamburgers from restaurants in the affected areas.
So it looks like these onions are, as you say, the culprit. They're removing them from the quarter pounders. Very sad what's going on with this severe E. coli outbreak. CDC coming out with that yesterday. Now they say 10 people have been hospitalized, including a child. Obviously, this is incredibly sad given the fact that, you know, there are McDonald's all over the United States and people go there. I will say, though, McDonald's has been under a ton of other political pressure as well, with Democratic senators in Washington, D.C. saying they're price gouging and they have too many high menu items.
Corporate profits must not come at the expense of people's ability to put food on the table. Not a great 24 hours for McDonald's.
No, I think that actually the E. coli thing is more serious than the proclamations.
Far more
DC.
serious.
I mean, not just when it comes to people's health, but also when it comes to reputational damage. We saw that with Chipotle for years after 2015, and there's a real question of how they're going to respond to this.
Just want to turn to the latest earnings as well from AT&T this morning. Just getting some results from them. EPS coming in at 60 cents, the estimate 57. Free cash flow 5.18 billion, the estimate 4.69. Lisa, I know you're going through these lines as well. What jumps out for you?
Well, revenue came in down almost 1% year over year, 0.7% year over year. But really, this is a beat. What I find interesting is it was a beat led by, guess what, the U.S. So we're going to go through the numbers and see what's going on. They continued and reaffirmed their expectations for the full year. You do see their shares lower as they do underperform in certain areas. But again, I'm sorry, you have to think about all of the misses in Europe and all the beats in the U.S., and you start seeing those headlines and you start feeling a theme.
I'm not sure this was an opportunity to take another dig at Europe, but here we are, another dig at Europe. AT&T is down by about 3.7% in the pre-market. I'm not getting defensive. Tesla, preparing to report third quarter earnings after the closing bell. Investors looking for details about the Cybercab unveiled earlier this month and any updates on a potential cheaper car in the works. Seth Goldstein of Morningstar writing, during the second quarter earnings call, management maintained its timeline for a new, more affordable vehicle to enter production next year. This vehicle will likely drive double-digit delivery growth in 2026 if production begins in 2025. Seth joins us now for more. Seth, welcome to the program. Do you expect any details on that a little bit later?
Well, I'm hoping we at least get an updated timeline. Last quarter, Elon Musk said we don't do product reveals during earnings calls. Those are separate events. So we might not get details like price or range or other auto specs, but I'm hoping we at least hear production is going to be maintained, or if not, there's a new timeline for the vehicle to enter production.
I've got a bias, Seth. The first thing I'll be looking for is how things are in China, given how much China's been in the news over the past few weeks. We've had mixed warnings on China. L'Oreal, LVMH, Starbucks overnight saying things aren't great. Then we had reports that things are okay with Apple's iPhone. What's your read on Tesla in China, in what I consider to be the most competitive auto market on the planet?
It definitely is the most competitive auto market on the planet. We have seen Tesla. There are reports from the CAAM saying that Tesla did see deliveries growth in China in the last couple months of the quarter. So I expect China will be stabilizing and slightly improving for Tesla as we see consumers demand more new energy vehicle sales, where EVs and plug-in hybrids are now more than 50% of all new autos sold for the past 2 months in China. So this benefits Tesla and their other EV peers, and I think China is not as bad as it was, say, a year ago or earlier this year. Is stabilizing or even improving for Tesla.
Seth, we were talking before for months about how Tesla is not a car company. It's ultimately an independent automotive company that can actually drive your car and have a robot that serves you dinner. And then there's some questions after the We Robot incident and some of the lack of progress or lack of clarity as far as when you start getting that autonomous vehicle kind of capability. How important is that in this earnings report?
I think we need to see more data points on the FSD software, something like user adoption rate. Certainly, I want to see if miles driven by the FSD software is growing exponentially, which is what management needs to see. Because remember, to get to a robotaxi from the current supervised full self-driving software, first there needs to be the wide launch of the unsupervised software for current Tesla drivers, and then it keeps improving there to be able to enable the robotaxi, the cybercab, and the cybervan to be deployed and be deployed safely in a manner that doesn't get them quickly undeployed from the roads due to an accident. So the first step is the initial launch of the unsupervised full self-driving next year in Texas and California. And to do that, to get there, we're going to need to see the FSD software continue to be trained and see exponential miles driven growth in this Q3 report. So I'm hoping we get that data again this quarter.
How crucial is that for you to maintain your equal weight or maintain basically your fairly valued assessment of its shares?
Well, I don't have much weight as far as the robotaxi business in my valuation, but what I do think is a differentiator for Tesla to grow deliveries, and I'm forecasting deliveries growth to a little under 5 million vehicles by 2030. And a differentiator for Tesla to get there is going to be the full self-driving software. And even if that's just a level 3 software that allows for current Tesla owners to have a much better and easier driving experience, that's still going to be a differentiator, which means the software needs to improve from where it is today.
When you think about Tesla and how much they're exposed to China when it comes to the batteries, we have the market pricing in this potentially Trump either win at the White House or actual red wave. What does that mean for a company like Tesla with walls going up when it comes to China, and also maybe the idea of the Inflation Reduction Act being pulled back and less subsidies for electric vehicles inside the United States?
Tesla's well positioned with manufacturing bases in the U.S., Europe, and China, so that somewhat insulates them from any potential tariffs or trade wars or protectionist policies. And I do think that even if the Inflation Reduction Act were to be pulled and Tesla no longer gets a $7,500 subsidy, what we're likely to see is a near-term dip in EV sales. But longer term, I point to the new, more affordable vehicles set to hit the road from the likes of Tesla, Ford, GM, and Hyundai, and Volkswagen, and the infrastructure bill from 2021 funding the build out of high-powered EV chargers along highways and in cities as the long-term catalyst for EV sales growth in the U.S. So longer term, I really see no impact no matter who wins the presidency. But should Trump win and reverse the Inflation Reduction Act, there could be a near-term hit to EV sales in the U.S.
Does it concern you that the C-suite of Tesla is so close to the politics currently?
Well, what I look for if I were to be concerned is this affecting Tesla's sales in the U.S.? Are voters who are Democrats being turned away from Tesla because of Elon Musk's closer relationship with Donald Trump? And so far, the data hasn't shown that. We've seen the Model Y grow, Cybertruck sales grow, Models S and X grow. Where we have seen the decline is in the lower priced Model 3s, but that's consistent with vehicles in that price category, which tells me that higher interest rates and are the major driver making the monthly payment unaffordable. But if the data were to show that we're seeing sales dips and Tesla's losing share, not only to other EVs, but to internal combustion engines in the same categories, then that could be a cause for concern. And Elon Musk and Donald Trump's relationship could be the catalyst for that concern.
Hey, Seth, it's good to hear from you. Thank you, sir. Seth Goldstein there of Morningstar. The numbers dropping from Tesla a little bit later after the closing bout. That stock this morning in the pre-market, just a touch softer, no drama. We're down by 0.7%. With an update on news elsewhere this morning, with your Bloomberg brief, is Danny Berger. Hey, Danny.
Hey, John. Blackstone's chief executive, Steve Schwarzman, believes the U.S. will avoid a recession regardless of who wins the White House. He said both candidates have policy proposals that appeal to growth. Overall, Schwarzman has a relatively positive outlook for the U.S. economy. As rates fall, he sees improving environments for deals and exits. Qualcomm shares falling in the pre-market trade 4.4% rather. The British chip maker ARM revoked a license that allowed Qualcomm to use its IP to design chips. ARM has given Qualcomm a 60-day notice for the cancellation. Such a move would roil the smartphone and PC markets and disrupt the finance and operations of two of the most influential companies in the semiconductor industry. Frontier Airlines exploring a renewed bid for Spirit. The Wall Street Journal reporting that the budget airlines have had recent discussions about a possible merger. People familiar said that the talks are at an early stage. If a deal between the two carriers is reached, it would likely be part of Spirit restructuring its debt and liabilities in bankruptcy, according to those people talking to the Journal. And that's your brief, John.
Danny, thank you. So is that deal allowed? That one can go through?
Potentially. The JetBlue one, obviously, the FTC wasn't too keen on, but maybe things are so bad for Spirit, they're going to have to let this go through.
So it's basically a threshold. How terrible is your business model? And if it's bad enough that you're not going to survive, all right, fine.
On the brink of bankruptcy or in bankruptcy, and we'll allow it to happen. Okay, that's where the bar is. Up next on the program, the easiest job in Washington.
It's the greatest job in government. You show up to the office once a month.
I have thousands of hardworking people. I can assure you that they work super hard every day, not just once a month.
That conversation up next.
Many global investors that aren't interested in China anymore, but there's a lot that are. And obviously the local investors have money in China and are doubling down on investing in China. Many of the Asian investors, and in fact a lot of the Middle East investors, the Americans are gone away. Therefore, there's an amazing opportunity to put capital to work and get returns which are excess what you would get in other places. Where there is lack of money, there is usually opportunity. So we continue to build out our business in China. It's just where the money's coming from is different. And so we're raising local money in China for investing and bringing those that choose to be there to invest in China. So it's just a different, where the money's coming from is just different.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Session lows at the moment. Big morning for earnings. Equity futures right now on the S&P 500 down by 0.2%. Big afternoon for earnings as well. We'll hear from Tesla after the close. Then next week, my favorite week in earnings season, we hear from all the major players in big tech.
And that really will be the key question in terms of whether we are correct in saying that their heydays are past them, that basically they can't upgrade, beat, and raise, can't be as much of a raise as it has been in the past. If that's not the case, can you imagine how much more people just rotate back into big tech?
I said all the biggest names in tech, and I should say, with the exception of NVIDIA, who needs to bring their earnings report forward, as we all know. Under surveillance this morning, the easiest job in Washington.
I think it's the greatest job in government. You show up to the office once a month and you say, let's see, flip a coin. And everybody talks about you like you're a god. Oh, what will he do?
It's the latest this morning. I took that personally too. It's kind of what we do every single month. The former president throwing shade at Fed Chair Jay Powell just last week. This week, ECB President Christine Lagarde jumping to his defense.
He should come and visit us. And, you know, I have thousands of hardworking people, economists, jurists, computer scientists, and I can assure you that they work super hard every day, not just once a month. I don't want to speak for Jay Powell, but I'm sure that's how he sees his job.
But I'm kind of speaking for Chair Powell. Joining us now, Mizuho host Jordan Rochester. Jordan, fantastic exchange between Francine Lacqua and Christine Lagarde just yesterday. I want your opinion on the following, a very pointed question. Who has the easiest job in central banking right now? Christine Lagarde or Jay Powell?
John, it depends on what you mean. So if you mean macro, I think the ECB have the easier job. Growth below potential, inflation below target, and all of the signals suggest it's not going to get better. So for them, making the decision whether to cut rates or not, it was a bit difficult in September. It's become much more obvious now with that October cut. They should be cutting rates at every single meeting. In the US, John, much more cloudy because you've got this fiscal spending that's happening in the background. Even though it's waning, you don't have that fiscal spending that you have in the US, in Europe. So Lagarde doesn't have the risk of really inflation bouncing back next year. I think that's a really low probability. But for the Fed, they do have that risk. And the labor markets continue to surprise us, even though all the data says from the surveys that they should get worse, they keep getting on better. So I think, John, the Fed has the harder decision on the macro. But in terms of the ECB, they've got 19 regional or national central banks to deal with, various different speeds, no harmonious union of the capital markets. So in that respect, it's harder.
So let's focus on the dollar side of the trade to begin with. Given everything you've just said, let's run with this. Let's say from your perspective, you have to confront the very real prospect of a red sweep. Let's see that's how things are playing out on November 5th overnight into November 6th. Do you think bond yields will be higher? I assume you do. Do you think that would be dollar negative or dollar positive?
That's one of the easiest questions, John. It's definitely a dollar positive because you're throwing tariffs on all your major trading partners. Now, the Eurozone doesn't have a free trade agreement. It would be in the sort of crosshairs of Trump if he was to come in. China's the clearer one. And when you have tariffs come into place, that lowers the competitiveness of the euro area, it lowers the competitiveness of China, and their currencies need to devalue versus the dollar, boosting the dollar to offset it. But then you've got free trade agreement partners. You've got Mexico, the land of great guacamole, but they've got a free trade agreement, and Trump wants to target his cars, their cars, that are coming into the US.
So there's the risk for 200% tariffs on Mexican exports of cars. I think that probably won't happen. I think it's a sort of positioning for a negotiation of USMCA by Trump. But you're looking at dollar MEX, you're looking at dollar renminbi, you're looking at euro dollar and dollar yen. All these countries have the risk of tariffs, and it means their currencies need to weaken. Jordan, it's interesting you say that's an easy one, because some people don't agree. And what was interesting from my perspective, listening to you speak, is you went straight to the trade story and didn't talk about the deficit story. And that's where my focus is. If you get a government that's going to issue a ton more debt, and we get the very real prospect of a buyer's strike in the bond market, I'm wondering whether we actually get that dollar strength. What's your pushback to that? Pushback is tariffs require no congressional approval, really. On USMCA it would, but on China tariffs won't, so Trump can do that. He needs Congress to get most of that fiscal done. And the difference between Liz Truss and Donald Trump is it's quite a long process to do that fiscal spend. All the planning that will go into it, it will take a few weeks to a few months. And by that point, there won't be a buyer's strike, because it probably just won't happen that you have that size of fiscal spending that he's proposed. Where with Liz Truss, she just threw the budget out there, and we knew that she had a majority in Parliament, so it probably would get through if she had the opportunity before having to step down. And so, very different political landscape. You've also got the US being the reserve currency of the world, where in the gilts market, that isn't the case, so you've got a buyer's strike. In the US Treasury market, yes, you'll see steepening of the curve potentially with that fiscal fear, but it won't be a buyer's strike, because the whole global financial machinery uses US rates.
At the same time, Jordan, you have to wonder whether, yeah, that might temper how much yields can rise. But does that also temper how violent the move could be in FX? In other words, even if people do believe that the U.S. will benefit more, that other companies will suffer more from potential tariffs, that people aren't going to be as aggressively going into the dollar because maybe of these some concerns.
Well, let's split it into the election. It's quite clear to me the dollar has to keep rising for three reasons. One is the swing states are moving in Trump's favor. Two is you've got the data surprises in the US are pretty healthy. And third is it's that tap on the shoulder moment. If Donald Trump wins this election and you didn't hedge for it in your book, your boss will tap you on the shoulder and say, what were you doing? So you're having this basically consistent demand for hedges over the event. After the event, I agree, it gets a bit more tricky, but because we know the outcome, if it's a red sweep, you know there's a very high chance of tariffs going into place. So the dollar continues to strengthen. We're looking for 157 in dollar yen, 103 in euro, for example, if that was to happen. But then we get to next year. And I remember 2017, we got to the start of 2017, when Trump had just won in November 2016, everybody was bulled up on the dollar, and it petered out, it turned lower and went lower. That's the risk, because it might be the case he softens his positions on tariffs. It might be the case that he doesn't get his plans through Congress. So I think next year will be a lot harder, and it might be the case that the dollar strength continues in Q1 and Q2, which is when I think the tariffs will probably happen. Q3, I actually think the European data, the Chinese data, will be bouncing back from the lows. Interesting. And so things improve. Hey, Jordan, it's good to catch up. Got to squeeze in a congratulations for Aston Villa. You can run away with that. Jordan Rochester of Mizuho. Appreciate it, buddy. Thank you. Euro dollar 107.79. Up next, Kevin Gordon of Charles Schwab, Evan Roth-Smith of Slingshot Strategies, George Ferguson of Bloomberg Intelligence, Matt Hornback of Morgan Stanley, and the latest numbers from Coca-Cola, just around the corner.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
One of the institutions you've been very philanthropic with is your alma mater, Harvard. But recently, you've been very public about your criticism of the way Harvard handled the events of October 7th and their aftermath. Could you talk about that now?
The first reaction of a group of 34 Harvard student clubs on the morning after October 7th was to put out a statement saying that Israel was 100% responsible for the acts of Hamas. And my view on that was, that's ridiculous. You can come out and say, look, I'm very unhappy about Israel's treatment of Palestinians in the West Bank, or you can say, we can talk about the Gaza Strip, but you can't support terrorists, and particularly terrorists that rape and pillage and murder and burn and take hostages. Well, I got actually a text from a CEO in my industry. He's like, Bill, you know the people at Harvard. I'd like to know who the students are behind these clubs, so I make sure I don't inadvertently hire them. And so I tweeted out that sort of made that point, and caused a bit of a firestorm, and I got a lot of pushback. Why are you picking on students? And I said, look, you can't hide behind a corporate entity if you're going to support terrorism.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
That move higher in yields is more about a growth pickup than it is about anything related to necessarily concerns about inflation.
Growth has been much more resilient than people expected.
Taking the totality of the data, the mosaic of what's going on in the incoming data, it still tells me that we are in the no landing scenario.
You're going to have a recession to kind of clear the deck of all the abnormalities that are out in the economy.
Don't get over your skis, because this market is not contemplating any kind of growth slowdown or any kind of inflation reacceleration.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
We are poised for a third day of losses potentially. Muted losses, but losses. We're down by 0.25% on the S&P 500 on a big morning for earnings in America. Numbers from AT&T, IBM, from Boeing, from Coca-Cola, from Tesla, from Coca-Cola, Elisa, just moments ago.
Yeah, coming out, beating across the board, talking about 77 cents, the earnings per share versus 74 cents expected. The revenue coming in $11.95 billion versus the $11.6 billion expected. Basically, this is a similar story to what we saw over at Heineken, where weaker actual unit sales were made up for by the increase in price. This from James Quincy, the CEO of Coca-Cola. Our business continues to demonstrate resilience in the face of dynamic external environments. So just talking, and maybe not talking about weakness, but their ability to really continue to raise prices stands out to me.
Things that the Starbucks CEO would love to say this morning, but cannot. Starbucks in early trading not doing so well. After hours yesterday, down pretty hard in the pre-market following numbers from that company. The numbers not pretty. Suspending guidance for 2025. The United States, softer transactions there, down by 10%. China down by 14%. The stock is lower by 4.6%.
A bigger question for Starbucks is sort of more of an existential question as Brian Nichols takes over as CEO and maybe clears the decks by withdrawing any type of guidance for the full year, but a question of what Starbucks is going to look like. Will there be fewer stores? Will there be more baristas? Will there be cheaper lattes? I mean, honestly, you start to wonder, have they reached the tipping point where people start saying, no, you are not going to buy another $7 latte. I promise you, if you come back with another receipt, I'm going to get very angry.
This is clearly very personal to your children, but it does feel like, is this the bottom for Starbucks, or potentially, are they going to have more quarters of just less growth, less transaction? You look at the research, Morgan Stanley, remarkably poor. Jefferies, tough road ahead. Edward Jones, there's going to be some tough quarters moving forward. So it feels like they're not out of the woods yet.
The coffee's always been too expensive. That's not a new problem.
Yes, but there's a threshold.
The consumer experience is trash. That's the threshold.
Okay, well, that actually
you
is
walk
something...
in there, some of the stores are a dumpster fire.
You're correct.
It's been like that way for years.
Part of this is actually free bathrooms. I'm serious. I think that a lot of people go in there, and then it becomes sort of a question of who hangs out there. But I also think there is this issue of how many more baristas are they going to get in, and that certainly was an issue for Brian Nichols.
You're both sounding like my boomer father. And one is the issue is when you order Starbucks now, you can just do it on your app. So you walk in, it's there waiting for you. You literally can spend less than 10 seconds in the store. I don't know what you're complaining about.
And that experience is trash. I've seen it. I've gone into the store with you. It's all lined up, people's coffee, all sitting there in plastic containers.
Hold
you
on.
think that's
You
a
pick
premium?
it up,
You think that's a premium experience to walk in there and see that?
It's efficient.
John doesn't even drink coffee.
Look, clearly my view, I drink decaf. And clearly my view, I'm not lonely on this point.
No, you're not.
Sales were down.
Yeah, you're right.
Transactions were down 10%. You're looking at me like I'm nuts, and the numbers speak for themselves. The stock is lower.
And not just the numbers, but people who work at those stores also have been complaining that they're understaffed, they're overwhelmed, they have difficulty managing everything. And that, I think, is something that is a very big issue that Starbucks is looking to address.
You think Brian Nichols there because things are going well?
I think it's idiosyncratic to the Starbucks you visit. I only go to 2. And I know the people there, and I do it all on the mobile app.
Okay, let's see if you get a free coffee for this a little bit later. Starbucks is down by about 4.5%. Coming up this hour, Kevin Gordon of Charles Schwab as the equity market rally stalls, Evan Roth-Smith of Slingshot Strategies on closing arguments on the campaign trail, and Matt Hornback of Morgan Stanley on why Trump 2.0 may not spell disaster for the bond market. We begin this hour with stocks and bonds heading for a third day of losses as the list of concerns continues to grow, including Federal Reserve policy and the election outcome. Kevin Gordon of Charles Schwab looking at one more potential liability, saying frothy sentiment is likely the biggest risk for stocks right now. Animal spirits are not back to their highs earlier this year, but they have moved into extreme optimism territory. Kevin joins us for more. Kevin, good morning.
Good morning.
How are you gauging that? How do you measure that? Extreme optimism territory.
We take an aggregate of attitudinal and behavioral metrics, so you can look at everything from AAII and what investors are saying on a weekly basis, whether they're bullish or bearish or in the neutral camp, all the way to actual positioning and fund flows into ETFs. And I know we talked about this last time, this kind of spread sometimes between what's going on in the attitudinal universe, what's going on in the behavioral universe. You're starting to see a little bit more pickup on the attitudinal side to match what has been still pretty frothy sentiment on the behavioral side. So if investors had been saying over the past couple of weeks or past couple of months that they hadn't been feeling as good about the market, their positioning didn't really reflect that. So it's now the case where, you know, again, to the quote you just pulled, you're not yet back at that extreme optimism, you know, sort of peak euphoria territory. You are hovering into that zone now. And really all it does is make the market more vulnerable to any kind of negative catalyst, whether it's geopolitical related, whether it's Fed related, whether it's economic growth related. You can take your pick because we've had all of those so far this year. But I think it's more important to assess that that's the backdrop. It's not necessarily this favorable backdrop of everything is sort of pessimistic, or at least trading in that pessimistic territory where, you know, you're not going to get as much of a hit in the face of a negative catalyst.
So with that in mind, what are you advocating for, particularly going into a big event risk in 2 weeks' time?
You know, I think, of course, the election can be a volatility driver. I do think some of the volatility that's come up to the index, not just stayed, you know, within sort of below the surface at the individual stock level, since the midsummer has been a good thing, because you're not going into the election with just this coiled spring of volatility. Even in the bond market, where you've had much more volatility than the stock market, if you're comparing the move to the VIX, I do think it's been actually a better environment where some of that has come up and bubbled up to the surface. Obviously, it's not great to go through, you know, drawdowns that are led by tech when you had that midsummer one and tech fell by 15%. But this has also been rotational in nature, where every drawdown that we've gone through so far this year, every period of weakness, there has been this offsetting strength from other parts of the market at times, and that's ultimately kept the indexes afloat. So even though you've had all this churn under the surface, I think it's a better way to go through some of these stealth corrections, or even for some parts of the market, these stealth rolling bear markets.
So I'll just ask you your own question. Is the 2-year-old bull too legit to quit?
Probably right now, yeah, I would say. You know, what's interesting about this bull market, it's so unique in so many ways. The first year, I would characterize it as probably the weakest in history, because you had at times a record low percentage of companies outperforming the S&P, whether it was on a trailing 1 month, 3 month, 6 month basis. But in the first year, almost to the day, 2 sectors were actually down in the S&P, and it was staples and utilities. Not necessarily a terrible thing because they're a little bit more defensive in nature, but you never really see that in a bull market. Even the defensive parts of the market do rally when you go into a period of strength in that first year of the bull run. So the fact that that changed in the second year, where now they've started to catch up, in particular utilities have caught up, I think that's a relatively constructive backdrop. It probably shows that this catch-up momentum has some legs. But I think that, looking to the third year, historically, you do get more drawdown activity. You get a lot more volatility. It's less exciting. When you look at the earnings backdrop that we're in, things are less exciting from an equity market gain perspective. So I still think that there's, legs to this, but you could get bigger pullbacks maybe associated with what has been a strong momentum trade, because the momentum factor is having its best performance and best year since 1999.
We've been toggling with this idea of at what point bond yields start to really impede on potential returns for equity valuations. And you have to think, for small caps and for the equal weight, you have seen underperformance in tandem with yields rising to the highest levels going back to July 25th. At what point does that torpedo the entire thesis?
I think it depends. So whatever the level of yields we ultimately settle at for this next peak, it depends how we get there and what's pushing us there. So if we get there in a really rapid pace like you had last summer, from July to October, when you got to 5% on the 10-year, and it was much more about inflation concerns and maybe the economy overheating, that I think is obviously a more sinister scenario. What has changed this time is sort of twofold. Number one, this relationship and the correlation between bond yields and stock prices has gone back into positive territory. So it's not as hostile anymore, where every single day you're seeing a rise in yields, you're getting the subsequent decline in stocks. The second thing is that you're approaching this from a stronger and a relatively healthier breadth standpoint. So you've still got, even after yesterday and the day before with the weakness in the S&P, 76% of members trading above their 200-day moving average. So the band that we've been in this sort of 65 to 80% range for that metric alone this year has been just a firmer backdrop. And I think it sort of helps keep you, out of the mud a little bit if you do get hit with some of these corrections or some of these catalysts to the downside. And that's what you've seen in the corrections this year. Max drawdown for the S&P is 8.5%. That's pretty great. So I think that as long as you stay in that environment, and now you've got some breadth catch up from areas like the Russell 2000 and parts of the NASDAQ, that probably keeps you in a better spot, even if yields continue to creep higher.
So you mentioned two catalysts, geopolitics and the U.S. election. What if the U.S. election, though, is not clear-cut? In less than 2 weeks' time, you have Americans fully going to the polls, even though we have more than 20 million already voted. What if there's a contested election? What is the impact to the momentum on this market?
So, the tough part about that is that we don't really have a big sample size, and you can really only go back to one point in history where it was the 2000 election, and even that's such an interesting analog, and I think a non-analog in my opinion, because by the time you were going through that contested election, you were already in a bear market. Bear market started in March of 2000, didn't end until October of 2002. You had a recession sandwiched in between that from March of 01 to November of 01. So automatically right there, I think that sort of puts that aside as this clear analog. So I don't think that we can use any point in history, which I know is, the knee-jerk reaction of investors to do so. But, we're in a totally different economic environment. Even the election setup itself, the possibility for the House and the Senate flipping, and the possibility for, the president to become maybe the former president again or the current vice president now. There's so many nuances and differences that I don't think you can sort of look back at any point in history and use that as a guide.
Do you think people coming on this program and some of the hedge fund managers talking to Wall Street Journal, et cetera, saying they're putting on Trump trades, are they getting over their skis?
So I get confused about what a Trump trade is versus what a Harris trade is, because if you look at it from a sector perspective, and we often use the energy sector as a pretty clear, and I know it's been discussed a lot on this program before, but there was probably this conventional wisdom that when you had the Trump administration, it was going to be really pro-energy. You could look at the rhetoric, you could look at the policies. The reality is, from inauguration day to inauguration day, 2017 to 21, energy was the worst performer. It was the only sector that was down. It was down by 40%. Vice versa, you can flip it on its head. Energy has been the best performing sector since Biden took office. So I don't, that's sort of, that argument in and of itself is kind of this clearest way of saying, I don't necessarily know what a Trump trade is or what a Harris trade is. I've seen everybody sort of put together, not everybody, but a good chunk of people put together these sort of old economy industries that would do well under Trump and vice versa under Harris. But you can look at just industry leadership throughout both administrations, and it doesn't really add up.
Is it easy to say that one is the status quo and one be a real game changer for the bond market?
No, because I think,
I
think it depends on what you're tying it to. If you're tying it to deficits and debt, there seems to be, for a while now, bipartisan support for who cares when it comes to spending. So I don't really know what the impact is going to be. Plus, we've done a lot of work on this. My colleagues, Lizanne Saunders, Kathy Jones, Mike Townsend, we collectively wrote an article back in the summer about looking at a lot of relationships within all the markets that we cover. Kathy in particular has looked at bond yields and inflation related to debts and deficits. And no matter which way you slice and dice it, the change in debt, the level of debt, the change in deficits, there is no strong correlation between that and yields or inflation. So I do think it's something to worry about. It's by definition unsustainable in terms of the trajectory we're on. But in terms of the market impact itself, it's really hard to tie that back to, in particular, the bond market and inflation.
Final question. How defensive are you about Starbucks coffee? As defensive as Anne-Marie?
I drink the coffee that we have at the office, so I'm neutral on this. Yeah, and at Bloomberg I drink this
coffee. So. The best, apparently. Kevin, thank you, sir. Appreciate it. It's good to see you. Thank you. Kevin Gordon there of Charles Schwab. With an update on news elsewhere, with your latest stories in your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Some earnings to get through. Hilton shares falling 4% in the pre-market. It reported revenue that rose compared to a year ago, but it fell short of Wall Street estimates. Despite adding new hotels, lower travel demand hurt Hilton and led to it lowering its 2024 profit outlook. Third quarter results were also hit from worker strikes and Hurricane Helene. Coca-Cola shares also lower this morning, 2.5%. Reporting earnings moments ago, volatile session this morning. It beat on third quarter earnings thanks in part to price increases, but unit volumes did fall. It lifted its adjusted organic revenue for the year to 10%, up from its range of 9 to 10. In the release, the CEO said that the business continues to demonstrate resilience in the face of a dynamic external environment. Apple CEO Tim Cook is meeting with the top technology officials in China. In his second trip to China this year, Cook pledged to deepen Apple's investments into the country. They also reportedly discussed cloud services and cybersecurity. China remains Apple's most important market outside of the U.S. iPhone sales, 16 sales that is, they are up 20% compared to last year's model. And that's your brief, John.
Danny, save me. They're dropping F-bombs about Starbucks around the table.
Well, you brought it up.
Up next. I'm doing a tease. Up next. You wanted to jump in more on coffee?
Well, I'm a niche user, as you say. I like the coconut milk cappuccinos. Can't really get that everywhere.
That's going to get Brian Nickel paid, that's for sure. Up next, closing arguments on the campaign trail.
My plans are focused on working people, the middle class, and what we must do to strengthen hardworking people.
With 4 more years of Kamala Harris, North Carolina will be an economic wasteland. That's what's going to happen. We don't need another 4. No country could take that.
That conversation up next.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
there is this real momentum from Wall Street.
We are basically deep in the European earnings season. Take a look at how we're faring when it comes to Asian markets.
Equities on the S&P 500 just a little bit softer. We're down by 0.2%. Under surveillance this morning, closing arguments on the campaign trail.
My plans are focused on working people, the middle class, and what we must do to strengthen hardworking people to be able to do what they dream and aspire to be able to do. His plans are about giving tax cuts, massive tax cuts, to billionaires and big corporations.
With 4 more years of Kamala Harris, North Carolina will be an economic wasteland. That's what's going to happen. The rest of your companies are going to move out. Everybody knows that. The smart people know. We don't need another 4. No country could take that.
So here's the latest. Kamala Harris and Donald Trump looking to sway voters with less than 2 weeks until Election Day. Pollster Evan Roth-Smith writing the best testing closing arguments against Trump are those that emphasize his lack of support from his former cabinet and numerous Republicans. Slingshot's Evan Roth-Smith joins us now for more. Evan, welcome back. It's good to see you.
Thank you.
I see commercials like that absolutely everywhere, which begs the question.
Swing states, and every poll shows this closing up to a very, very tight race. This is what every pollster has been saying for months, right? This is going to, not just pollsters, it's going to be a 50-50 race. It's going to be really, really tight, but now we're living that reality because the polls have gotten there.
Evan, you say this is their best test in terms of their message they need to get out. And it comes at a time when you have John Kelly speaking to the New York Times, and he basically says that Trump is the definition of fascism.
Mm-hmm.
Is this, though, diluted in the sense that we have heard this for years for members who were part of Trump 1.0?
Well, so this was the best testing closing argument we had in terms of going after Trump, right? The kind of language you saw from her around her mission, her goals around the economy, around working people, and Donald Trump as a patsy of the wealthy and who will cut taxes and who will be fiscally irresponsible as well, as sort of the undertone to that, is still the best thing for her to say about herself. But yes, many people in the electorate are worried about this. We hit Nikki Haley voters, people who supported her in the primary, who are Republicans instinctually on policy, are worried about things like a former Trump White House chief of staff coming out and saying the guy's a fascist, don't let him back in.
They've been doing a lot of campaign events with Liz Cheney, but then you hear from Governor Tim Walz, who says, well, we want her to be a part of Kamala Harris's campaign to talk about the fact, to give basically this idea to Republicans, it's okay, you can vote for Kamala Harris. At the same time, he said, we're not going to take any of their foreign policy advice. Mm-hmm. So what are you getting if you are, say, a Nikki Haley Republican and thinking about voting for Kamala Harris?
You're getting some sense of security that the Democrats are not this foreign entity that you can't cross over, that it would be verboten for you to cross over to. Nikki Haley voters in our polling, these people are really Republicans. They're Republicans on economic policy. They're Republicans on immigration policy. They're Republicans on just about everything. They love George W. Bush. They love Condoleezza Rice. They love that era of Republican politics. And there's a lot of push out of the Republican Party from Donald Trump on them. They do not like Donald Trump. But we need to establish some pull into the Democratic Party if they're ever going to cross over, because they've already voted against Donald Trump once in the primary. And what the Democratic Party needs to do is to get them to vote against him a second time. That's a fairly tall order, but you need to make them comfortable doing something that their entire lives they've rarely done, which is vote for a Democrat for president. And that's what Liz Cheney is there to do.
Kamala Harris was asked on The View what separates her from Joe Biden. She said, well, really, nothing really comes to mind. How bad was that for her?
That was pretty bad. We tested it out. It was the worst possible thing she could have said in that moment compared to the other things we tested.
Why wasn't she prepared for that question?
I think she was prepared. I just think she has hang-ups, and I don't think they're ill-considered or dismissible around how it's perceived for a vice president to be disloyal to their president. Also, by the way, for the first female vice president to be disloyal to their president, for the first black vice president to be disloyal to their president. It's sort of a cruel joke of history that to elect the first woman president, she's now been tasked in the final weeks with some supreme act of disloyalty against Joe Biden, right? That's pretty messed up. But she's dialed that answer in, right? We saw it yesterday in that NBC interview, I believe. She gave a much more pointed answer about price gouging and housing prices. So she's gotten there. She's gotten more comfortable with it. But she's a loyal, dedicated member of this administration.
Do you think that it's a good thing for her to go on Joe Rogan's show after Trump?
Yeah, I think it's a great idea. I think she should absolutely do it. Not just because any time that she goes out and does an interview and talks to people, it works. We tested all sorts of clips, even moments we didn't think were particularly good from those first rounds of things she did with people like Oprah. And 60% of of voters who saw clips of her doing interviews were like, that was great. Even if those of us in the media and politics would have gone, I would have tweaked that this way, that way. So when she goes on these media appearances, it works for her.
At this point, we are seeing the polls seem to favor Donald Trump. We're seeing that pretty much across the board. You're kind of nodding back and forth. Last time you were on, you said that you think pollsters are so self-conscious about getting it wrong in terms of not skewing the data enough to Donald Trump that they're actually overweighting him. Do you still think that?
I think the odds of an error in this election, a polling error, likely are a polling error in favor of Kamala Harris. And there are a couple pieces of evidence that might support that. One is, frankly, the last time we had a black candidate at the top of the ticket. Barack Obama in 2012, polling underestimated him by 6 points in any given swing state, because polling is good at establishing what a given electorate is going to do. It's not always so good at picking up at changes in the electorate, like the kind of high turnout you get from black voters when there's a black president on offer. And the other thing is the last election we have, the 2022 elections, was a polling miss in favor of Republicans, right? That overestimated Republican support. So people like to talk about the 2020 miss, the 2016 miss, but the last national election we had in the 2022 midterms was a large multi-point miss that overestimated Republican support. So I think there's plenty of reason to believe that if there is a polling error, and by the way, I don't think there necessarily will be a polling error, but if there is one, that Kamala Harris is a likely beneficiary of that error rather than someone who will be punished by it.
We've got to squeeze this in. This weekend, Harris is in Texas. Donald Trump is around the corner at Madison Square Garden here in New York City. What is going on there? What do you think that's all about?
It's the attention war. It's the attention war. You can go to Wisconsin 20 million times. You can go to North Carolina 20 million times. But these closing weeks of the election, you have to get into people's living rooms, not just the people who come out to a rally to see their favorite candidate. You have to get attention. You have to get chyrons. You have to win the news day. And doing a big rally at MSG or doing a big appearance potentially with some sort of celebrity maybe in Houston is a way to do that, and a way to at least, these people have jets. They can go back into the swing states the next 5 minutes. So winning the attention battle with a couple hours of your time and then going back to the campaign trail is not a silly way to spend your time.
It's getting a lot of attention, that's for sure. Evan, it's good to see you. Thank you, sir. Evan Ross Smith there of Slingshot Strategies. Up next on this program, Boeing results just after the commercial break, plus an update on the health scare over at McDonald's. That stock is down by almost 7% in a pre-market. From New York, with equity futures on the S&P 500 negative by 0.2%. Bond yields just a little bit higher, through the curve up a single basis point. The 2-year out to 30s, 10s at 4.22, a 2-year at 4.04. From New York City, you're watching Bloomberg TV.
countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
As we spend some time here on the broader presidential race,
Let's focus in on European politics.
Makes you wonder how politics might play out.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Numbers from Boeing dropping any moment now. Equity futures on the S&P 500 down by 0.2%. On the Nasdaq, we're down by a third. On the Russell, down by a third of 1%. Also, plenty of earnings through the morning. We've heard from AT&T and Coca-Cola already. No real drama from either of those names.
No, although what you could see is AT&T just getting pressured a little bit on equipment sales. I want to dig through that to understand what their iPhone sales and their financing is like and their partnerships there. With Coca-Cola, they're able to raise their prices to offset some lower volumes, and that, I think, is pretty interesting.
Tesla coming up a little bit later after the closing bell. Boeing just crossing at the moment. Just seeing a headline from the CEO. Boeing to reset priorities and create a leaner organization. Lisa's got the numbers.
Yeah, revenue for the third quarter is $17.84 billion. The estimate is $17.89 billion. The third quarter negative operating cash flow was $1.35 billion. The estimated was a negative $1.99 billion, so less of a loss than people had expected. The new Boeing CEO, Ortberg, saying that they need to improve execution discipline. But to me, what this really highlights is it sort of staves off some of the worst case scenarios. The third quarter negative adjusted free cash flow was $1.96 billion. The expectation was for less than that, a lesser negative of $1.87 billion. So still some issues they're working through.
That stock is down by about 0.5%. To work through the numbers with us, I'm pleased to say that joining us is George Ferguson of Bloomberg Intelligence. George, Lisa went straight to that free cash flow number. Walk us through what you were expecting relative to what we got.
Yeah, so I mean, I thought it was decent numbers, right? So I think the market's really focused on his cash flow. I think cash flow could have been worse than that, about negative $2 billion. I think when you got the free cash flow line, because I think we're very concerned about the amount of money they need to run the company. We knew they were at about $10.5 billion in cash balances. That's about the bottom of what they need, to run the company. That's why we've seen them file the shelf offering for the $25 billion. I think they may wait and see if they get a union vote, positive union vote today, to decide how much they want to go into the marketplace and raise, equity. There'll be some pretty heavy dilution. There's only, about 90 billion in market cap last I looked on this company. You raise 25 billion, that's really, that's over 25% dilution. I think something you don't want to do to the existing shareholders. And frankly, I thought, revenue numbers not bad. The second quarter really wasn't bad for deliveries. It was lighter than we expected. The longer the strike drags on, the more we get concerned that it's harder to restart the supply chain and get moving back towards 30 plus 737 deliveries a month. That's the secret to the recovery. And so I guess, for Kelly Ortberg, really all the action is tonight, and it's all about how that union vote comes in, whether or not they can restart some plants, try to get happy union workers back into the factory.
George, we can see that the shares are kind of fluctuating between gains and losses as people try to understand how the actual earnings stack up with some expectations that have been lowered again and again and again. George, when you look at the line items, this is not great performance pretty much across the board. A miss for defense, space, and security revenue, a miss for global service revenue, a miss for negative operating cash. I mean, a lot of questions here about how much you end up with a company that has cut costs, not necessarily paying some of the workers who are on strike, but really don't have any growth. How can Kelly Ortberg really give a sense of what this company is going to look like, what the growth engines are going to be in a couple of years' time?
He can't. Well, today he can't, right? And so again, I think the whole path forward, the entire recovery is all built on getting those union members back in the factory, but getting them back in at a wage rate and at a benefit level where you can still make money in this business. And then he's got to start to build 737 airplanes. That's the whole path. And so, like I said, you know, a lot of sort of 2Q is rearview mirror. It's all about getting this union contract done. You gotta, you know, again, you gotta think about this. These airplanes are almost custom made, right? There's automation on these lines, but these are skilled workers that put these airplanes together. He has to get them back into the factory and happy and excited about making Boeing airplanes, not just drag them in, you know, barely. And so that will be a lot of the challenge here too, is he has to get, as he gets an agreement, goes for an agreement with the union.
So 5 p.m. Seattle time, you said that's when the fireworks are going to be. Do you think the agreement that's been discussed gets it done?
It's close. Look, I think the union members have been out of work for about a month. I don't know that I could survive a month without a paycheck, without health care. They got 35%. I think they may have wanted 40. It's pretty darn close. They gave him a sweetener on the 401k. I think he's going to get it, but it's close.
We'll see a little bit later on. Appreciate the update, George. Thank you, sir. George Ferguson there of Bloomberg Intelligence. That stock just about unchanged. The big decision, really, bigger than the earnings, is whether we can actually strike a deal and that company can get back to trying to produce some planes. And based on some of the commentary this morning, maybe in the future design a brand new one. Lisa, this goes to your point, and you've been focused on this, I know, over the last month or so, defending that investment-grade credit rating. This came from Kelly Ortberg. I'm confident that we have a good path forward to manage the realities of our business and retain our investment-grade rating.
This is a huge issue for borrowing costs, especially at a time where they need to raise capital. We saw that with the stock share sale. How much are they going to end up in this sort of spiral downward where their costs of interest payment are going up at the same time that they need to borrow to invest to start creating that new model that you're talking about? And that's, you know, some of the hangovers that this company has to deal with, even as they just try to get production back online with their workers.
This is a stock to watch going into the opening bell and after hours as well when we find out the outcome from that vote. Two other names to watch going into the cash open. McDonald's under pressure after an E. coli outbreak tied to the company's quarter-pounder hamburgers sickened dozens of U.S. customers. The CDC saying one person is dead. The stock is down by close to 7%. Elsewhere, Starbucks pulling its guidance for 2025, with sales plunging for a third straight quarter, demonstrating the scope of issues facing new CEO Brian Niccol. That name is down by 4%. Joining us now is Michael Hayden of Bloomberg Intelligence. Michael, we'll split these two stories up because they are very, very different. We'll get to Starbucks in just a moment. McDonald's, stock is getting hammered. What's your view on what's taking place and how quickly this company can move past it?
Yeah, they're going to be in the penalty box for a while. You know, it was a tragedy. Obviously, there's going to be a ton of bad press around it. You know, the most recent one we can look to was Chipotle. Their same-store sales dropped for 5 straight quarters. They dropped 20% in 2017. I don't think this will be as bad because Starbucks was kind of unique. There was rolling issues right after the E. coli, then norovirus started to pop up in a bunch of different stores, and so that you know, caused the issues to kind of extend a little bit longer. Also, it was a more complicated situation at Starbucks, right? Their food is out in the open behind a sneeze glass, right? And so there's more opportunities for pathogens to get into the into the food make line. Whereas, you know, McDonald's, we think this could be an easier solve. You know, if you just start grilling your onions, that would take a lot of the risk out of the situation for them. So, you know, what we wrote yesterday was that we think sales and traffic will probably be impacted for about a year.
For a year. Mike, you're saying that it's not necessarily the same as Chipotle, and Chipotle had a much longer runway in terms of it needing to heal some of its relations with its customers. For McDonald's, how much does this raise a question about supply chain issues and what kind of scrutiny there is over some of the suppliers, since this was a specific supplier that they believe who supplied the sliced onions?
Yeah, well, there's no doubt that this is going to have to be addressed, right? And management is going to have to do a good job on this upcoming earnings call, making people aware, and then also through their PR arm, make people aware that they're doing the correct things in terms of food safety, to make sure that you know, the food that they're serving is okay. And so, you know, listen, it's unfortunate that it happened. You know, it's a big risk in this industry. It's one of the worst things that can happen for a restaurant chain, right? And so they're going to have to, I guess, pay their penance and prove to customers in the street that they're doing the right things to make sure that their customers are safe.
Also bad when it happens to companies that people wake up and realize that $7 is too much to pay for a vanilla bean latte. And that's sort of a question around Starbucks, this question of how much they have to completely rejigger the business model at a time where sales are slumping 10% in the U.S., 14% over in China. Yes, a new CEO suspending guidance. What's your takeaway of how significant the overhaul of the business model has to be in order to bring it back to its former dominance?
You know, listen, it's a big lift, but this preliminary earnings release doesn't you know, change my opinion of Brian Niccol or his ability to turn this around. It doesn't make me any more concerned, right? To me, this is old news. He's been in the role for a month. Anyone who's been following this story knows how bad the last few quarters have been. We've been writing for over a year now about weakness this fiscal year, right? And so this wasn't a surprise to us at all. You know, if I'm Brian Niccol, and actually it's not a bad thing at all, because you know, he's got easier comps to lap for next year, and you know, we think that they can post positive same-store sales growth here in the U.S. and China, partly because they're lapping such weak results from this past year, but then also, you know, by instilling a culture of accountability, transparency, trust, right? Getting the right members of management in the right positions, right? He made a switch in China, and they just hired a chief marketing officer, and you know, they're also going to ramp up the marketing once they get the operations right. You know, yesterday on his video, he talked a lot about reducing the number of SKUs and the number of drinks that they're making, because, you know, as you know, I'm sure you've heard over the last year, you know, there's been a lot of new items added to the menu, a lot of new limited time offers that made baristas' jobs really difficult.
Maybe
right?
too many new items. Michael, what market do you think is easier for the new CEO to turn around, China or the United States?
I'm going to say the United States, because he has a ton of experience, you know, in this market. So I would go with the United States. I'd say China's a little bit more difficult, because the gap between their price gap between them and their competitors is just very, very wide. I mean, they're selling coffee that's sometimes 3 times more expensive than Luckin and K Coffee. And so I think China's going to be a much tougher turnaround than the United States.
Michael, appreciate the update, sir. Thank you. Michael Hayden there of Bloomberg Intelligence. That stock recovering just a little bit. It's down by about 3% in the pre-market. Under surveillance this morning, Boeing reporting third-quarter results that missed Wall Street estimates. In his first public presentation, CEO Kelly Ortberg saying the company has, quote, some really big rocks that we need to get behind us to move the company forward. Factory workers will vote on a new contract proposal later today in hopes of ending a 5-week-long strike. That name is down by 0.4%. Elsewhere, Secretary of State Antony Blinken in Saudi Arabia, as the administration continues to push for a ceasefire between Israel and Iranian-backed militants. Blinken reiterating that Israel shouldn't retaliate after Iran's missile attack earlier this month.
So you have the Secretary of State now going to Saudi Arabia, going to be seeing the Crown Prince Mohammed bin Salman. Again, his 11th trip to the region since October 7th. He's come back empty-handed every single time, but I think this trip is very different. We are less than 2 weeks out from the U.S. presidential election. I think this administration is just buying time. And Israel cannot retaliate with the Secretary of State in the Gulf.
Can't they?
I don't think so. I think that crosses a line. Maybe when he leaves, but...
We've crossed a lot of lines over the last few months, that's for sure, haven't we?
It would be very convenient if this got resolved and the Middle East had a peace deal before November 6th, November 5th. I don't think that that's necessarily going to be so easy to get right now, given how quickly things have been escalating.
One final story here for you. ARM Holdings is scrapping a license that allowed longtime partner Qualcomm to use IP to design chips. The move ratcheting up a legal battle between the firms and also threatening the semiconductor industry. Qualcomm sells hundreds of millions of processors annually. Both of those names down this morning.
What's so interesting about this is it goes to the question of Apple trying to integrate artificial intelligence versus Samsung and the Android. Qualcomm provides a lot of the AI-related features for Android phones. If they can't use this key feature, how much does that diminish their ability to inject AI types of technology at the same time that Cristiano Amon came out and basically said, we're on it, everyone's going to have AI on their phones, and we're going to be the leading ones on this.
Don't have much AI on my phone. Don't know about you.
Well, I mean, a personal assistant. If it could make a coffee, if it could make a vanilla latte for $4, I would put it on my phone.
Back to the coffee again. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Bank of America CEO Brian Moynihan is urging the Fed to be more measured. He spoke exclusively to Bloomberg on a trip to Australia.
So we've got to get back in line. And so they're on that path. They were late to the game. They got to make sure they don't go too hard now. And that's what they are all trying to figure out watching the data.
Moynihan said that he expects the Fed to cut rates by 50 basis points by the end of the year. Texas Instruments rising in the pre-market trade 3.2%. It reported positive third-quarter earnings that helped overshadow the U.S. chipmaker's disappointing forecast for the fourth quarter. Texas Instruments CEO said that the timing is right for recovery following 8 straight quarters of revenue decline. Nielsen says that Game 5 of the WNBA Finals was the most viewed in 25 years. Viewership peaked at 3.3 million viewers in the decisive game between New York and Minnesota. Overall numbers for this year's finals came in up 115% compared to last year's. Fans who tuned in were treated to an electric overtime finish that saw New York take home its first ever title. And that's your brief, John.
Danny, thank you. Appreciate it. Up next on the program, dissecting a bond market sell-off.
I think that move higher in yields is more about a growth pickup than it is about anything related to necessarily concerns about inflation. I think the market's going to get back to what is the foundational elements of the markets that we're seeing today.
That conversation up next, live from New York City this morning. Good morning.
Top names in business are on Bloomberg.
The challenge for us now is not very much on the product, it's on the ramp-up of the production system.
We turned the industry down to almost zero during the pandemic. And what we're trying to do now is turn it all the way back on. And that's hard. We lost not only people during the pandemic, we lost a tremendous amount of experience.
A lot of skilled people have left the industry. We have to hire new people. The supply chain has to hire new resources and train the people, educate them.
And because those roles are filled now not by a 58-year-old, but perhaps by a 28-year-old. There's a lot we have to do in terms of not only adding capacity, but capability to meet the ramp that we all are embarked upon.
We have thousands of suppliers, and when you have just a couple of them, few of them that are late on the ramp up, well, that's slowing down everybody, and that's what we've been facing earlier this year.
Nobody covers business like Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
It was going to keep Real World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Treasury's down once again this morning. Yields higher by 2 basis points. The 10-year 422.76. Under surveillance this morning, dissecting a bond market sell-off.
I think that move higher in yields is more about a growth pickup than it is about anything related to necessarily concerns about inflation. It would seem unlikely that the bond market and the equity market would be pricing in today a more complete picture of how this election is going to unfold. There's going to be the knee-jerk reaction, as there always is. We could get a bear steepener of the yield curve in the event of a Trump victory. But then I think the market's going to get back to what is the foundational elements of the markets that we're seeing today.
Here's the latest. 10-year Treasury yields trading near 4-month highs as investors confront better economic data and the prospect of a Trump 2.0 presidency. Morgan Stanley's Matt Hornback thinks the bond market is less exposed this time around, writing, many investors see the Republican sweep outcome as most bearish for U.S. Treasuries. We think any rise in Treasury yields would be more contained than in 2016, based on a comparison between expectations for Fed policy today versus then. I'm pleased to say that a good friend of ours, Matt Hornback, joins us now. Matt, let's jump into that story together. Give me some more detail on that. The bigger difference now, between now and 2016.
Yeah, John, well, the differences extend well beyond what people expect the Fed to deliver over the course of the next couple of years. But certainly the Fed is a very big part of the story. In 2016, we have to remember that, Janet Yellen's Fed was about to embark on a rate hiking cycle. It was the second time they were trying to start it up, and investors generally expected the Fed to be hiking rates very gradually going into that election. In the wake of that election, of course, investors changed their minds very quickly, and over the course of that next year, revised higher their expectations for Fed policy to the tune of about 1.25%. Now, 1.25% doesn't sound like that big of a deal today because we've just lived through 525 basis points worth of rate hikes in 2022 and 23. But back then, 125 basis points was quite a big deal. And so if we take that number, John, and we apply it to today's environment, that would essentially be the same thing as saying that investors would go from expecting the Fed to cut rates modestly to no more rate cuts in this cycle. And that's a leap that I don't think investors are going to make in this particular cycle, which ultimately means that the bond market sell-off will be more contained.
Matt, there's an argument that this time is different because the deficit is different. It's significantly bigger. We just had a cycle where we got fiscal stimulus into a growing economy, a healthy economy by many measures. Why is the deficit issues not a concern for you? And I'm not talking about the short end or the specific rates tied to Fed policy, but the long-term rates that are more hinged to the fiscal outlook potentially.
Lisa, I'm really glad that you asked me this question. I have a strong view that in the end, What moves the bond market are how investors change their expectations for fiscal policy or for Treasury supply. And if you ask every investor in the marketplace today whether we are going to have bigger deficits in the future, irrespective of the election outcome, to a person, you will hear the view that, yes, we will have larger deficits. It's already expected by most investors, and therefore it is already in the price to a certain degree. And the question then is, what type of deficits do we get over the next 5 years relative to what people expect already? That's going to be the most important part of the bond market reaction to this election. And so in the end, it's how people's expectations change vis-a-vis the deficit is what ultimately moves bond markets in any given period of time.
That said, Matt, given how bearish some people are getting on bond yields and the expectation we heard from T. Rowe Price that potentially we could get 5% on a 10-year yield, how aggressively are you buying longer-term bonds right now on some of the backup?
Yeah, well, look, I certainly think that there's value in the Treasury market, but a lot of that value depends on knowing an outcome that at this point in time is unknowable. So what we've been telling investors is to hug their benchmarks tightly and wait for the opportunity to arise in the wake of the election, an outcome of which is very uncertain. In addition, the timing that we will know that outcome is also somewhat uncertain, and therefore I think investors are best placed to hug their benchmarks tightly. Investors are best placed to hug their benchmarks tightly. And so in terms of the duration exposure, Lisa, it's really about where you think any additional Treasury supply will come. And in the end, when the Treasury increases coupon issuance, they don't do so just in the 30-year Treasury bond. They increase supply generally across the yield curve. And so for investors out there who are worried about higher deficits, who think that those deficits will be larger than the marketplace is priced for, my recommendation is to be underweight the intermediate sector of the yield curve, not necessarily the long end, because in the end, when the Treasury increases supply, they're going to do it across the curve, and so the weighted average of that supply is going to hit most strongly in the intermediate sector of the curve, the 5 to 10 year sector.
Matt, I've got 40 seconds left. I want to squeeze this in. Dollar stronger against everything in G10. The intraday chart of dollar yen today is just this slow and steady march up and to the right. 152.96, about to break through 153. What's the story there?
Well, I think largely the story is the U.S. economy has once again proven more resilient than fears had suggested. And as a result of the interest rate complex moving higher, taking real returns in the U.S. higher, that's going to attract capital into the U.S. It's going to put upward pressure on the U.S. dollar. Of course, just like there's some degree of a pricing of a potential election outcome, there's probably something going on in the dollar just the past week, really, that is perhaps putting some higher probabilities on an outcome involving tariffs. And a lot of investors think that the dollar is going to go up on tariffs.
Matt, appreciate it. Matt Hornback of Morgan Stanley. That's one to watch today, close to 153 on dollar yen. Up next, Alicia Levine of BNY Wealth, Republican Senator Tom Tillis of North Carolina, Francis Donald of RBC, and Troy Gajewski of FS Investments. The third hour of Bloomberg Surveillance, just around the corner.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Why should I want to invest in the pharmaceutical industry? Is it going to continue to grow as it did last year? And what about your own company? Do you think it's going to have good growth prospects over the next couple of years?
I think the reason to invest in the sector is the science. I mean, when you look again, if I go back into the history, for most of the last century, we were only giving people pills and small molecule drugs. Then we discovered that we had this whole world of biologics, and we could treat diseases with biologicals. More recently, we've discovered that we can reprogram your cells, we can edit the genome, we can use these RNA therapeutics to completely transform areas of medicine. Those technology areas are at their very nascent stage, and what we're going to find is they're going to open up whole new areas of growth from our business standpoint and a human health impact standpoint. We hope that as we work in our areas like cell therapy and RNA therapeutics, we will also be able to climb to a whole other level of market cap over time.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
The US equity market has done so incredibly well. It's been an incredibly strong performing market.
I do still think that corporate earnings are actually still doing quite well.
At the end of the day, valuation does tend to matter. I don't think valuation is dead.
We think that valuation discipline probably is the most important thing to have at this time.
Focus is so much on the Mega 7 and following the trend there that a lot of these different pockets of the markets are beginning to see some fundamental momentum.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning to you all. 90 minutes away from the opening bell. The third hour of Bloomberg Surveillance starts right now with equity futures on the S&P 500 just a little bit softer. We're down by 0.2%. The first back-to-back losses on the S&P since early September. I didn't realize it's been that long. That's quite a stretch. The S&P this morning, a little softer on the NASDAQ, down 0.4%. We've talked lots about the earnings today. The calendar's absolutely packed. After the closing bell, we'll hear from the likes of Tesla. We'll hear from IBM. Already heard from Boeing, AT&T, and Coca-Cola.
Yeah, some disappointments here. Boeing obviously is in a world of hurt, and they continued that world of hurt with some disappointing numbers, in particular about free cash flow being more negative than people previously expected. AT&T, just a marginal disappointment. I thought that it was interesting what we got out of some of the consumer-facing brands. The idea that we do see on the margins some negativity, even unit sales in Coca-Cola coming in a little bit soft, but they were able to raise prices in order to offset that. So again, still pricing pressure, but consumers, I don't know, the $7 latte. I don't want to keep going back to it. I'm not going to do it again.
Don't get Anne-Marie started
I'm
on the
not going to do it
$7
again.
latte. So defensive about Starbucks this morning. I've got no idea why. We'll get to that a little bit later. Let's get back to the macro. Through the week, you're going to hear more and more headlines from central bankers and government officials from the IMF World Bank fall meetings down in Washington, D.C. Bramo's going to be down there. And this is how they kicked it off. By lowering its global growth forecast for next year, the risks are building up to the downside. There is a growing uncertainty in the global economy.
And they talk about the $100 trillion of global debt and how the fiscal overhang is creating a bit of a problem. They also talk about geopolitical concerns, not necessarily downgrading U.S. growth and the whole overall year forecast pretty much in line, but how much do they sort of present a remedy to it at a time where some of these global organizations don't have the same kind of clout. You hear about what's going on over with the BRICS conference and Vladimir Putin talking about how this truly is a multipolar world. How does the IMF grapple with that?
And also at the same time, Kevin Gordon coming on and saying, yes, this very bullish momentum right now, but two massive catalysts right now. One, geopolitically, what's going on in the Middle East, but then also the U.S. election. City out today, directionless. A dearth of data and polls that show a close presidential election have left markets without a clear direction. Even though some people coming on saying it's a Trump trade, really is it? Or is it just the fact that it doesn't matter who's going to be winning? There's going to be a lot of spending.
There's a quote that jumps out from the IMF that I want to share with you all. There is a rise of protectionism, protectionist policies, disruptions in trade that could also affect global activity. For who? And it just made me think yesterday, after we just had a conversation with Torsten Slok of Apollo, who's talking about a no landing in the US economy, and none of that stuff came up. I just thought, our policies, your problem. That seems to be the message coming from the Trump campaign to Washington, D.C. and the IMF World Bank, full meetings.
And Wall Street strategists saying, yep, that's pretty much what's going to happen. That's the reason why the dollar is expected to strengthen. That's the reason why a lot of people are looking at how to build out in the U.S. It does raise a sort of awkward moment to be having these meetings in Washington, D.C. for the IMF talking about protectionist policies at the same time that has been carried through with this administration as well. And that, I think, is going to be a real tension that needs to be tossed out.
Exactly. So when you have them coming out and they say tariffs are going to be bad, they're going to be bad for the rest of the world. Well, this administration also kept tariffs in place. So yes, they might be more drastic under the former president, but you can't say there's not going to be tariffs or export controls or the idea of an ally not being able to buy a U.S. company under the Democrats as well. There's protectionism across the board.
Have you noticed it's a tax when they do it, but it's national security when we do it?
It's branding.
Yeah, there is a real branding difference down in Washington, D.C. Equity futures on the S&P 500, negative by 0.25%. Coming up this hour, we'll catch up with Alicia Levine of BNY Wealth as markets pause on Fed cut fears. North Carolina Senator Tom Tillis on Hurricane Helene recovery efforts, and Francis Donald of RBC on the shape of the U.S. economy. We begin this hour with stocks lower and bond yields inching higher as investors rethink Fed policy and the prospect of a second Trump presidency. But Alicia Levine of BNY Wealth seeing opportunity, writing markets have not lived up to the September dread and October flush. As previous years, we think the market melts up into the end of the year with some volatility around the very close election. Markets like certainty. Alicia joins us now to provide some of that certainty. Good morning.
Good morning.
Good to see you. Got to get into the election. How much of what we're seeing, cross-asset, in foreign exchange, in bonds, is the so-called Trump trade making a comeback?
So I wouldn't say it's a Trump trade. I would say it's the polls have moved slightly in Trump's favor, and so the trades are being put on. And if you look at what happened in 2016, the dollar strengthened, the banks skyrocketed. That's already happened before the election. So the trades early. And I think some of the bond yields as well that we've seen in the last couple of weeks is also part of thinking about some of the inflationary aspects of whoever wins this election. So, there's inflation on both sides of this. I think but everyone, to the extent that, people may be doing a Trump trade, I think it's overdone given the 50-50 nature of the polls. I mean, the pollsters are telling you they don't know who's going to win this thing.
You remember that morning in November 2016. We all do.
It was a long
night. At the time.
It was a long night.
I was up all night. We all were. The equity market was down. It was down hard. And then I remember that sort of acceptance speech, and he starts uttering things like infrastructure spending. And this market just rebounded. It got bought aggressively, and the Trump trade was off to the races, and everyone got on board. Do you see less chance of that happening this time around? Because Matt Hornback of Morgan Stanley was making the point, like you have just now, that perhaps we're better prepared for this than we were back in 2016.
Well, we're more aware of it, and the market's already priced some of it in. And so you're not going to get those sectors or that immediate reaction, because if it's already priced in, it's not a surprise. And markets, if they price it in, the event itself is sometimes sell on the news. So I don't think this is going to be a great momentous thing. I think that we've been telling our clients that never to invest with your politics or what you think the politics are of the moment, because ultimately, if you take 2 steps back and look at the markets over a cycle, the politics or the political configuration actually does not affect your assets or your asset classes or the stock market. That is a very important thing to keep in mind as we head into the last 2 weeks of this election cycle, where people are feeling hot, depressed, thrilled, a combination of both, worried. It doesn't matter to market performance. It's the fundamentals of the U.S. economy and earnings and interest rates. That's what we focus on, and that's where we try to keep our clients.
So you see buy on the rumor and buy on the news, basically buy maybe even more on the news, at least in equities. I'm wondering if it's the same in the bond space at a time when you've been selling on the rumor. Some people are speculating you sell more. Matt Harmbach pushing against that, saying we all know this and it's nothing really that new. How much can you get that rally in stocks if you don't get a commensurate rally in bonds?
So I don't think the bond move is going to be dependent on who wins the election. Like, we've just moved 60 basis points on the 10-year. That's a pretty dramatic move. So one could say the move has been done as it relates to pricing in what's going to happen with the election. Ultimately, I think the deficit and the debt are bigger issues than who wins this election here, because, as I said, if there is a divided Congress, neither of these two candidates, whomever wins, is going to be able to get their full spending plan through. It's just not going to happen. So there's going to be a little bit more of a ceiling on what each candidate can do as they win. But again, that's with a split Congress.
But I guess that it just goes to this question of, we've seen the rotation kind of rotate back a little bit with big tech outperforming over the past few sessions. And I'm just wondering whether that's the new trend, the new sort of narrative in markets, if we do get a sustaining of these types of yields.
So, as we've spoken about many mornings at this wonderful table, you know, we see tech both as defensive and offensive. And right now it's playing the defense because of the cash flow and the earnings and the margin, and being entirely not connected to what's happening in the bond market because they can run their businesses without borrowing. So to that extent, like, if you look at the beginning of the fourth quarter, you know, tech has outperformed. It's outperformed because it's sort of been, you know, the third quarter was all about cyclicals. It was about value. It was about financials coming back. And then you saw that, you know, the tech take over again for the fourth quarter. I think you're likely to see that into the end of the year, because if there's any uncertainty at all at outcome or policy, it's the safety trade, right? These large cash flow generating companies that can protect your portfolio, that's where investors are going to go, I think, until there's some certainty on outcome and policy.
So basically, if there's uncertainty for a few days, you don't know the outcome of the election, or it's a contested election, tech does well?
I think tech does well.
So is that what you want to be buying if you're very concerned? Do you think this drags on for weeks or months?
We don't do election trades. We just think that the market will be fine because tech is, between communication services and tech, IT, it's almost 40% of the S&P. So we think you're protected there.
What else?
It's more about, you know, this is why you shouldn't sell the market if you're nervous over election results, because the strongest and best companies which play defense in uncertain markets with strong dollar and high yields can do well.